Good morning, everybody. Good morning, good morning. Let me start by saying that YouTube is running. Good morning, Ron. Good morning, Cab. I've got it running. We are recording. So I apologize about yesterday, guys. I even got messages from some of the salespeople asking when I was going to post. I was like, there was a problem there. But that's okay. I know which lesson you guys really drilled me on yesterday. And I turned it into a PowerPoint for later in the classroom. I'm working on using my inside voice. Apparently, I talk really loud when I get excited. Guys, if you can't hear me, let me know. But I'm trying to keep my volume down a little bit. Um, we're going to go through today, and I put this in the room, guys. The idiom, there's more than one way to skin a cat. Of course, it's a horrific image, but it's just it's a metaphor. There's always more than one way to do something, guys. There's so many ways to do things. And when we talk about the software, I sure did, Steve. And Steve, I even built you a PowerPoint based on that lesson yesterday. We'll go through it today. I had guilt. More than one way to do things, guys. Awesome. No, I'm not sleepy. I'm trying to be mellow. So my wife and I are going to start traveling again. And if I have to teach from hotel rooms, I've got to learn to control my volume a little bit on the way to wherever we're going. It's easy at home. I just close the office door. She's on the other side of the house, and it's absolutely no worries. I want to just talk a little bit. Most people, when they start with Nexgen, they evaluate the software, they talk to a client advisor, and from what I'm told, I've never gone through the sales process. The goal is to be able to see the potential to make between $400 and $500 a day. I like that. $400 a day, guys, is a six-figure income based on trading. The goal of this classroom is to give you the path of least resistance to find your $400 or $500. And we do that with what we call a high probability trade. And a high probability trend trade, it's been taught by Nexgen for decades. Every chart, every indicator agrees with the rules for the trade. It is the best of the best, guys. It's the highest probability. It's typically the least amount of risk. And I teach in this first hour the best of the best way to take that trade. And that's the focus every morning, is giving you this very core concept so that you can see the potential, so that you can reach your potential, and then ultimately so you can create your own path. So as we move forward and we go through this first hour, remember, everything that I'm telling you revolves around the best way to use the software as a brand new user. Everything that I teach is strategic. When I talk about advantages, I'm doing it for a reason, guys. I don't waste many words. I do babble a lot, but the babbles typically have meaning. So we're going to move forward. We're going to get going. And as always, we're going to start with news, guys. Every morning, high impact news, medium impact news, it can affect the market. Hey, good morning, Roy. It's good to see you. So today is Wednesday, April 30th, and of course at 8:15, 8:30, we had quite a bit of news. At 9:45, there's the Chicago PMI. Doesn't really phase us. It's a low impact. But then as we get into the 10 o'clock hour, guys, we have more news. We have more high impact news. And if you watch the bottom fall out of the NASDAQ, when news hit, somebody reacted. And their reaction can change patterns, guys. And all we do is trade patterns. So every morning I come through and I look for these red boxes. And if I see one, I choose not to trade during that time. I typically, if I'm in a position, I'll exit 3 to 4 minutes before, and then I'll let the news release. If there's a reaction, great. And as soon as I can feel comfortable and confident that I can trade my patterns, that I can get my stops and targets in the correct spot based on the speed of the market, I'll resume trading. So 10 a.m., we've got that high impact. We'll see what kind of reaction it gives. And then for you crude oil traders, this is the only low impact news that I pay attention to, because it's crude oil inventories. And crude oil inventories are when they release the barrel count or something like that. But there's always, almost always, crude oil traders on either side, buys and sells. And they're waiting for that. And there's a reaction that happens. And crude can become very untradeable during the release. So each and every morning, make this a part of your routine, guys. There's 2 or 3 things that I do every morning before I ever look at a chart. News is one of them. And then I review my trades from the previous day, and I set myself up for the day. And we're going to talk about all that stuff. Everything that I talk about, all the rules that I discuss, the looks that we present, guys, it's all in the trading guide from the education tab. And if you look at the trading plan rules, the trading plan, I'm going to give you a plan today. I'm going to give you what's called the KISS plan. And the KISS plan is the most basic, highest probability, designed to optimize your chances of success plan that I've ever come up with. And that's what we teach for an entire hour, is how to find the entry for this KISS plan. And we do it with the high probability trend trade. Because that high probability trade, guys, as it's taught, and if you follow the rules, is a trade that typically wins 70 to 80% of the time. And that's not me just blowing smoke, and I want you to doubt it, but I'm going to teach you how to study it. I'm going to teach you how to prove that it actually does. I'm going to teach you how to go back and see this pattern and verify it and build that trust in it. There's a saying that says confidence comes from the memory of success. So the more success you experience, especially in the early stages of learning the software, guys, the more apt you are to focus on following rules, to focus on having advantages, to focus on taking the best trades. And eventually you realize that you don't have to be in every move in the market to find success. You can limit yourself to the best moves, to the highest probability moves, and still have the potential to reach your goals. The most important reason that I teach this high probability trend trade first is because it's going to teach you to read your indicators. Your software is a tool, and that's the easiest way to say it. Your software is the world's greatest hammer. It's the best elliptical you could ever buy. It's the race car that you have to learn how to drive, guys. You've got to learn to use the tool, and that's what this classroom is designed for. And the high probability trend trade teaches you to understand what these indicators are telling you. And what you're going to realize, and you'll realize this within the first week because you're going to learn some patience, is that 90% of your day, 90% of the overall process of being a day trader isn't taking trades. It's doing nothing. It's actually sitting on your hands because you are so confident in the methodology that you're trading, because you know it produces more wins than losses, that you're actually pretty adamant about sitting on your hands until your advantages are present. And that's how we present in this room. 10% of your day, you will be trading. You'll realize that you have an edge, that you see a pattern that's been proven to win more than it loses, and you can't wait to get into that market, and you can't wait to take advantage of those things that are producing the trade. Once you can read your indicators, once you can recognize the information they're providing, and it doesn't take long, and I'm going to streamline the focus for you, you will understand where the market is likely to continue. And this becomes your entry for trend trades. You will understand where the market is likely to go. This is going to help you with targets as you grow with the software. And then I think the most important lesson that you're going to take from this very basic trade is that you're going to understand where the market is likely to stop, where the strongest trend ever has the potential to just end in reverse, where all the forward motion could just hit the brakes and back it on up. And these 3 concepts, guys, they're going to carry their way into everything that you do, and you're going to be able to see these, recognize these, and take advantage of these by learning the high probability trend trade first. And the high probability trend trade is only 3 rules. And only is in all caps, guys. We as humans try to complicate things. We do our best to add things because we believe more is better. And when you're talking about trading, very often, the fewer moving parts you have, the easier it is to find success. So of only 3 rules, each rule, when true, provides an advantage, guys. And the recipe for a trade for the brand new user is combining 3 advantages. So strong triggers, rule number 1, give the advantage of momentum, guys. And momentum means that the overall opinion of the market is that it's headed a direction and it's headed that way fast. And it's difficult to stop the advantage of momentum. And then the second rule, no termination conditions, is telling you don't trade into an area that could stop the market so that you have room to your profit targets. We're going to call that the advantage of a clear path. So when I have momentum, the market is screaming in the direction of the trend. And then with absolutely nothing in the way to create a bounce or stop it, guys, this is the core advantage. These are the two things that when you learn to piece these together, you'll find more opportunities. Once you understand momentum and path, you'll find a way to get paid. And you're going to see a lot of variations in this room where people depend solely on momentum and path. For the brand new user, we're going to add a third rule, and it's going to be the entry rule. And the entry rule is just designed to put you into the market right where the market's most likely to continue with an established trend, to continue with all that momentum, and to continue with that clear path. And we discuss this entry first because it's going to create some concepts that'll pay dividends as you go down the road. It's going to help you with stop placements. It's going to help you understanding how price reacts to these trigger lines that we use. So this is a very strategic approach to getting you where you need to be in the shortest amount of time possible. And we're going to do it with only 3 rules. And I think this is great. We're going to do it with only 2 charts. Guys, there's a myriad of charts that you can use. There's range charts, and there's minute charts, and there's big, huge time frames. You know, I need a year chart to know the overall. Guys, we're going to take 2 charts. We're going to take a big chart and a small chart. These are dynamic Renko bars, and they're based on ticks. They're not based on time, which means that it takes price movement to create these bars. On your large chart, the first bar, the first printing bar, the active bar, the one that's going up and down, it's all you need to define the direction of the market, to know that you're trading with the trend. It's all you need to define the momentum through rule number 1 and have that advantage, and it's all you need to define areas and making sure that you have a clear path through rule number 2. So your large chart takes care of your first 2 rules. Your large chart leads the way, and only when the first 2 rules are in play, brand new users, should you go to the small chart. And the small chart is a refinement chart. The small chart is a chart that takes the inner workings of that one bar, and it shows you everything going on inside of it over the course of about 20 to 30 bars, depending on what the move is. So the black box around the one bar on my large chart, all of these bars are printing on your smaller, faster chart. So we use that smaller, faster chart to refine that broad stroke of a brush and pinpoint where the market is most likely to continue, your best of the best spot. And that's going to allow you to reduce risk as a new user. That's going to allow you to maximize your profit potential. And rule number 3 is nothing more than an entry rule. And the small chart is only gone to when the first 2 rules are in play, when those advantages are present. And we're using these 2 charts. And I love this metaphor. Who are you trading with? Who are you trading against? Your large chart, think of them as the large, it's the big crew, it's the institutional traders. It's the men and women with the money and the power to create a trend and to establish momentum. And these are the same people that are making decisions right at those key areas that you're going to see on your large chart. And when you go with the flow, when you follow the large crowd, when you go with their trend and you accept their momentum and you don't trade into their decision-making points, guys, the large crowd typically wins. You can be a part of the winning team by following the large crowd. The small chart is the small crowd. These are your fighters. These are the men and women with more money and influence than we'll ever have, and they create what's called a retracement, which is just a tiny little shove against everything that the big crowd wants. We rely on their fight because they lose this fight, typically 70 to 80% of the time. Rule number 3, your entry rule on that smaller, faster chart, is designed to put you in the market right where their fight is most likely to fail, which means that you have the potential to win up to 70 to 80% of the time by simply following the rules and learning the advantages of this highest probability trend trade. The way this classroom is designed is we take the morning and you get to learn the trigger line and the Fibonacci rules for when it's okay to trade. That's a magical phrase, when it's okay to trade. It's okay to trade when you have the three advantages. It's okay to trade when your rules are met, because your rules you'll be able to prove, you'll be able to test, you'll be able to verify, and eventually you'll be able to learn to trust that your rules are a pattern that win more than they lose. That's when it's okay to trade. And as you get going, try to adhere to the idea that if my rules aren't met, if my advantages aren't in play, I choose not to take a trade. Trading doesn't have to be a gamble. It doesn't have to be about hope. It really is simply patterns. You have the ability to simulate with NinjaTrader. You can take trades in a live market. Guys, you have NinjaTrader, you have a working copy of the software. The market's going to go up, the market's going to go down. You're going to have everything that you need to be able to take trades, to practice these rules, to work on stop placement. The step-by-step path to becoming a confident trader ASAP, it begins with you posting in my room. I am the warm, fuzzy Novak, guys. I'm a victory celebrating kind of guy, and I'm, at the risk of sounding a little egotistical, I'm really good at reading these indicators and understanding what's going through your brain as you do what you do. So if you take a minute and you post in my room, and more importantly, here's how to annotate a chart. I want you to go back, and everything you drop in my room, I want you to talk about the momentum that you see, and I want you to explain to me whether you believed you had a clear path or it was a termination condition, and I want you to show me your entries, and I even love to see your exits. And what you're doing every time you post in the room is you're getting a private session. I'm going to open up your charts. We're going to talk about what you saw. I'm going to make sure that you're seeing things correctly. We're going to look at your entry and make sure that it was the lowest possible risk entry. We're going to look at your exits, make sure that it makes sense. If you're doing things wonderfully, you'll get that feedback, a lot of virtual high fives and gold stars. And if you're doing something wrong, if there's a misread, if there's an aggressive entry, if there's a hold too long, guys, we'll talk about it. We'll point it out. We'll talk about why it creates a challenge for you. And then most importantly, we'll go through and we'll come up with a plan together to help you avoid the things that are robbing your success. So post in the room. Don't be shy. You can't post too much. You can't overpost. I want to see every trade that you take. I especially want to see the losers. That's where the education tends to have the most. I can't wait. And it's an easy one, Todd. I saw it yesterday and I almost replied in here, but we're going to start with yours. And I'm going to show you just how easy it is to not get turned around the way you did. So it'll be fun. You'll be the first picture that we look at in the second hour. Or we can do this, guys. When you post in the room, hold on, let me scroll up to Todd's picture. This is what's going to happen. Is I'm going to open up your chart and I'm going to say, okay, Todd, let's talk about some of the very basic lessons. If the background is red, the market's going down, and your path of least resistance is to look for trades to go down with this market. And when the smalls are outside of the large, it's fighting those triggers rarely works out. Sometimes it does, and it did here, it seems. And I'm still not sure how you made money on this one. Everything says down. Your triggers say down. And you're arbitrarily buying these blue lines, believing that they will stop the market, that they'll create a bounce. Does that sound about right, Todd? You saw the blue line and you thought, oh my gosh, I have to go long. And you saw another blue line and you said, whoa, I have to go long. And that's okay. We can talk about that today. So what I'm going to do is we're going to look at this and I'm going to take a picture of it because you didn't annotate it. And I'm going to give you some feedback. And I'm going to say red means down, which is pretty basic. And I'm going to say triggers are down. And I'm going to say everything says down, Todd. Everything says down. I should be looking to go down with it. And it's okay, but what we're doing is I'm giving an example of how the feedback's going to be. But I'm not just going to do that, right? I'm going to give you this picture. And you'll be able to put it into the spreadsheet that I gave you. You'll be able to study it if you choose to. And what happens is guys, the direction that Todd traded here, fighting everything, going against the direction, going against the momentum. I bring up this funny little picture that says, this is how you commit financial suicide, Todd. Fighting strong triggers, trading in determination conditions. That's the two things I'm going to try and keep you guys from doing. So we'll take a second, we'll talk about it. Yeah, and we're gonna talk about how to turn around the way you're thinking to go with that large crowd, reminding you that when these guys, when they want it to go down, it's going down. And that's exactly what we saw, right? No, Todd, you're okay. You're brand new. You're like, let me practice entries, right? Let me practice getting into the market. Todd, you're doing everything exactly where you need to be right now. But the great thing is when you do start taking trades, right? When you do start trying to capture profits, when you do start testing this plan, that's the feedback you're going to get, man. That's the feedback all you guys are going to get. Is we're going to go through everything that I see. We're going to look at what you did. We're going to talk about how to avoid mistakes. And if there was a victory, we'd celebrate it. But gee whiz, Todd, you fought everything. But I wanted to use that for an example. This is what we're going to do. And then Todd, what are you using to take pictures? Are you using capture software? Are you using Snagit? Using capture? Let me see if I can get my TechSmith capture to open, and I can't. I'm going to try and download it. But Todd, as far as annotating, there is a cool little video I would love for you to watch. And I will try to download the capture software too. And we'll go through it together. I've already signed up. Unfortunately, I had a glitch in mine somewhere. And I'm not sure why. I'm going to see if I can get that on there. Chris downloaded it for you? Awesome. That's okay. We'll find the pictures for you. But up at the very top, when you take a picture, Todd, there's a call-out box. And that's what you're going to type in. If anybody has capture software, do me a favor. Never mind, it's not going to let you show the picture of it. I'm going to keep going, and we'll talk about it. We'll get you where you need to be. And I may even have Chris come in and show you how to do it, because I'm going to have to download it again. But that's what happens every time you post in the room, guys. Every time you post in the room, we're going to talk. We're going to have a conversation. You're going to tell me what you saw. We're going to talk about how to fix it, how to repeat it, and how to do all that great stuff. And that really is, guys, the people that post the most get to where they want to be the fastest. We will also simplify. And that's what this first hour is, guys. This first hour is embracing the highest probability, best of the best. No, you can't monopolize the group's time, Todd. I'm in charge of the time clock, and as long as I want to talk, I get to talk. And I've had classrooms where we've devoted an hour of 3 to somebody's great questions, and I just get excited about it because that's what the education is with Nexgen, guys. Nobody gets left behind. You shouldn't ever feel like you're monopolizing time. This is your time. Be very, very stingy with it. And I'm pretty good. If I need to shorten it or cut it back, I will. But most of the time, I don't, and I choose not to. I'm going to give you guys a plan this morning, and it's called the KISS plan. And the KISS plan is designed to optimize your chances of success with a high probability trend trade. So as we go through these rules and we go through the entry sequences, guys, know that what we're doing is we're learning the absolute best, highest probability way to take a trade with the software. And then it's that understanding through the first trade that's going to open the doors for the rest of the trades, guys. You've got to learn what looks you're going to commit to. And that's all it is. It's just a pattern. And when you learn them, they become easy. And that's the second part of becoming a confident trader ASAP. It says track your real-time performance in a spreadsheet, but I'm really going to take it one beyond that. First, I'm going to put my spreadsheet into the room for you, updated almost every day. And my spreadsheet has 4 tabs. So I just dropped it in the chat box. Download it, get it on your computer, commit to using it every day. The first tab is the basic rules. So when we talk about strong triggers, that first rule, the whole green section there is what it looks like to have strong triggers. So Todd, if we look at your picture and you're going against those strong triggers, you're going to know it if you go through this drill. It also discusses what weakness looks like, because if I'm committed to trading when my rules are met, I'm also committed to trading when the pattern isn't present, and this is what it looks like when it's not. Same thing with having nothing in the way, and then I'm going to define what it looks like to have something in the way, and then your entries. And all this basic rules sheet it's creating recognition through repetition, through seeing the same thing repeatedly until it becomes easy. There's the client trade section in the green section here, and I can't wait to steal pictures from the new users doing it wonderfully. These are Nexgen users using momentum, path, and entry, or some variation, and finding their trades, taking their trades, and sharing them in the room, and me saying, wow, what an awesome usage of momentum, path, and entry. Let me take that picture, let me steal it from you, let me put it into this client trade section. And you new users, I encourage you to go through and start clicking on these, and it'll start to cement that pattern. There is the entry sequence, that small chart entry sequence designed to get you into the best of the best entry with the least amount of risk for both long and short trades. And then there's a lot of ideas on management. There's the very basic mechanical management plan that'll be on the plan I give you. And then some ideas of when you can start holding for bigger moves, or maybe when you should jump ship before things go bad. There's a page for you to build your plan. So when you post in my room and I'm like, wow, this is perfect, it follows every rule, you had every advantage, this is your pattern, you can start filling this up with pictures, guys. And I would encourage you, if you have a great looking picture, stare at it for 30 seconds before you start your trading day. Commit that look to memory. You'll begin to work on your own management plan, and you'll begin to see things. When the high probability trend trade becomes easy, that's when you start to find the opportunities beyond that trade. Ron C. in the room, I don't know if he's in here today, he said once long ago, and it stuck with me, the high probability trend trade isn't your only trade. It's not your get rich trade, guys. It's the one that teaches you to see your get rich trade. It's the one that teaches you to see the opportunities beyond that very basic trade. And then finally, this is where tracking your progress happens. On the 4th tab, all it is a trade journal. You're going to take a picture, and you are going to drop it in here. And then the important thing is you're going to drop the feedback that you get in the room. Take a second to put it in there. And if every morning, and guys, I still do this. This is a part of my daily routine every day. I go back every morning and I look at what I did yesterday. And as the brand new user, it may be 20 or 30 trades, but the more you learn to adhere to rules, you'll find that you're only taking maybe 5 or 6 trades a day and have the ability to hit your goals. But I ask myself every morning, what worked? And by doing this, I'm identifying patterns that are bringing me success. I'm identifying advantages that are bringing me success. I'm committing those looks to memory and committed to repeating them. And then I also ask myself what didn't work, guys. And for the new user, I think this is the more important of the two. Because very often new users maybe jump in when they shouldn't be jumping in, or they fight trends, right? What didn't work? Well, the one thing that doesn't work more often than it does is fighting everything going down and trying to go up. So I'm going to look at that and go, wow, that ran me over. I will, Rob. I'll do it the way I always do it. We'll get into it in the second hour for sure. And what you guys will find is trading doesn't have to be stressful. Trading is nothing more than the patterns, and you'll never be in control of the market. You'll never be in control of your results. The only thing you'll ever be in control of is knowing that you have those 3 advantages, and that tends to relax you. And the better you understand and trust those advantages, what you'll find is that when you deviate from your plan, and you will because you're human, you'll find that you feel a little nervous. You'll find that you move stops a little aggressively, that you shorten your targets even though the indicators say it may go more, because you'll know that you're creating challenges for yourself by not following rules. So using the spreadsheet, posting in the room, getting that feedback, guys, this has been time tested and proven. I encourage every post. I want to see everything, and as long as you tell me what you see, I can give you the absolute best feedback. So as we get into this first hour, what we're going to do is first we're going to learn what are the indicators. What am I looking at? Triggers show up on both charts, large and small, and they're the same. These are small triggers. Two solid lines work together to create the small triggers. They're a fast-moving average. Two dashed lines work together to create the large triggers. They're a slow-moving average. When they're up, small and large will be green. When they're down, small and large will be red. And that is really as extensive as you need to go into trigger lines. Trigger lines have nothing to do with price bars. Trigger lines have nothing to do with Fibonacci areas. Know the difference between small and large and between up and down. Both charts will have areas. And depending on the chart will depend on the role they play. But they all have names, and all I need is for you to learn the names. There's divergence highs. It's a magenta line, and this magenta line is screaming to you that there was a loss of momentum at this pivot. And Wayne in the room came up with this great little thing. The buyers were in control and everything was going up, and if the sellers say no more buyers, and they steal their momentum, you'll see a pink line. It's just a visual that there was a loss. And then the cyan line prints from a low. If you're not a colors guy, hot pink straight out of the 80s is magenta, and baby blue is cyan. You'll also see Fibonacci resistance. It's a red horizontal line. When the market's trending up, it could stop it. It could create a bounce. Very often, these are where the large crowd are making decisions. Fibonacci support is the equal opposite reaction. In a downtrend, these are where decisions may be made. All you need to know is that a red line is resistance and a blue line is support. You're also going to see Fibonacci, these yellow 1-to-1s. These are fibs that print in the moment. They can be support or resistance depending on which way the market's moving, but we learn to respect them. They're an area where decisions are made. And then you have a mid-band, and a mid-band is a exponential moving average, which is a very mathy term. All you need to know is that when price is above it, it's green. It could be support. When price is below it, it's magenta. It could be resistance. On the large chart, these are where decisions are made. On the large chart, these are what we're going to use for termination conditions. On the small chart, we'll use them for entries. And we use them for termination conditions or entries for the exact same reason. They can create a bounce. Rule number 1. We're getting into rules, guys. Interrupt me if you need to interrupt me. If you post in the room and you need help with tech or something, make sure you tell me that it's outside of the lesson. And if you have to go to work, let me know. I'll take a look at your chart early. Guys, large chart leads the way. The big slow chart, the large crowd. And the large chart, okay, you were gone for 3 minutes, no worries. So Rob, the format's the same. We're going to go through the rules, and then the second half of class, we'll start clicking on charts. If you have to leave for the day, if you need that review before I'm done with rules, let me know. But I prefer to drop the rules in there so we can talk about the advantages on your chart. But it's up to you. Large chart needs strong trigger lines because trigger lines, strong triggers, create the advantage of momentum. And the only way that you can have strong triggers is to trade with the trend. So here's the first lesson on the chart we saw earlier. No, class only started 30 minutes ago. Remember, you're an hour behind in Illinois, so it feels like it's been going for a couple. If the background on your large chart is green, the market's going up. If the background is red, it's going down. And the easiest, the path of least resistance, the best of the best, is to simply look for your rules to be met, trading with the trend. The only way you can have strong triggers in an uptrend is if both the small and the large triggers are green as well. So the trend is up, the smalls are up, the large are up, and I know that I can have strong triggers. And what strong triggers looks like in an uptrend is your small triggers are up and above the large triggers. The large triggers are wide, and there's space between the two. And what I want you to picture is, in order to have strong triggers, they should look like scissors that are open. Because when scissors are open, you can cut, you can get work done. So the colors match, and there's space between the small and large. In a downtrend, the colors match, and there's space between the small and large. And it's that space that defines the strong triggers. And when you have strong triggers, the odds are favorable for the market to continue up. The odds are favorable for the market continue down. So very often, you're going to see annotated on charts, odds favorable momentum. And one of the easiest ways to drain an account is to fight that momentum. So when you have strong triggers up, when you have strong triggers down, rule number one is in place. You have momentum. And guys, momentum can push a market in the direction of the trend. And momentum is exactly what we look for to break key Fibonacci areas, to have that potential. When you have strong triggers up or down, you can use this as a study tool. That one bar that lets you know that the triggers are strong, sometimes they sprout a tail or a wick, and that's the pullback. That's the refinement process on the smaller, faster chart. So anytime you see a tail with strong triggers, you can say to yourself, that was a potential entry. And rule number 3 has you pinpointing where these tails are most likely to form. And I think the greatest thing that momentum does for a brand new user is it'll cover some of the mistakes that you make. It'll help change your trading plan once you trust that this is the look that pushes a market. But momentum doesn't last all day, every day. Momentum goes away, guys. And when your scissors close, I think that's the greatest analogy. When your small triggers work their way inside of the large triggers, this is a weakening of the large triggers. And when you have a weakening of the large triggers, anything can happen up or down. I'm a big language nerd. And if I'm betting my money, I'm betting my money on strong when the odds are favorable for it to continue in the direction of my trade. And that also says, hey, I'm not going to fight a market that's strong and more likely to go down. And once that advantage goes away, it becomes easier to sit on your hands and do nothing to wait for that advantage, because weak triggers are very often where reversals happen right at key areas. Then you see it twice there. And strength has the potential to break areas. And I have to take this picture right here. And we're going to have a little digression, guys. Does everybody see this picture that I just took? And all right, Villas, have an awesome afternoon. If you go to the YouTube page and you go to the live market, this broadcast will be posted around noon Central, or I'm sorry, noon Eastern. Come back, watch the first hour 4 or 5 times. Get those in there, and hopefully we'll get a chance to talk and see some of your trades. I am, Wayne. I rarely make that mistake twice in a row. So guys, this is crude oil. And today's date is 4/30/25, not 35, 25. I want to see something, because when I see this pattern set up, it's important to me to show it to you guys. I'm going to go to the termination conditions section. We're about to talk about this rule. And this picture is from 2021, 4 years ago. And this is such a great illustration of how what we do is trade patterns. Because what happened in crude oil this morning happened in 2021. The market has a memory. And remember that, because that's going to pay dividends. Because what we're doing is we're learning how to capitalize on the memory that the market has. So I'm going to ask real quick, strong triggers. Separation between the small and the large. Could you give me a why in the room? If you're comfortable with that, if you're all right, if it makes sense. Separation means strength, and the only way to have rule number one met is if small, large, and background match, guys. And that's a little safeguard for you. Once you have momentum, once the market is screaming in the direction of the trend, guys, we got to make sure there's nothing in the way. No termination conditions. I want room to my profit targets. I'm going to insist on a clear path. And Todd, that's okay. 2 days to grasp, that's great. I'm not sure how old you are, but I mean, I'm almost 53. I figure I got another 30 years. If it takes me 2 days to do something, that's okay. I've got the next 30 years to take advantage of that lesson. So once momentum is second nature, let's go to termination conditions, guys. Termination conditions are just horizontal lines on a large chart. Remember, areas are defined on the large chart. These are the areas where the large crowd are most likely to make decisions. These are the areas that are most likely to stop the forward progress of the market, that can create a big untradeable bounce, that could reverse the market completely. And these are also the areas that have the potential to break, and you'll never know what the reaction is going to be. No matter how much you think you do, no matter how great your magic 8 ball or your crystal ball is, you'll never know what the reaction is going to be. You just know that the large crowd's likely to make decisions. I don't know what an intermediate move is, but I'm glad that you're finding a way to make more money. So guys, if these lines on a large chart can stop the market, if it's where the decisions are being made by a large crowd, by the people that control the market, the first step in identifying a termination condition is allow the price bars, allow the dynamic Renko bars to get to the area, whether it's resistance or support. Once price reaches an area, it sets off the decision-making process. And remember, the decision could be that it breaks, that it creates an untradeable bounce, that the buyers and sellers fight, or even that it reverses the market. But once price gets to the area, guys, we're done with price. We are done with price. The trigger lines will tell the story. So once price reaches an area, that's the first step. You just have to ask yourself, where are your triggers? And if your triggers remain below resistance, resistance is a termination condition. You'll never know what the reaction is going to be. So your highest chance of success, your largest advantage, comes from waiting for the reaction rather than hoping that it breaks. And then price comes down and reaches Fibonacci support. You ask yourself, where are the triggers? And the triggers remain above support. It may reverse the market. It could create an untradeable bounce. It might break. There may be a fight. I don't know what the reaction is going to be. So rule number 2 says that if price reaches an area and the triggers remain below resistance or above support, it's a termination condition. Rule number 2 is not met. Absolutely no trades going back into that area. And I want you to see, I'm going to open up the live market, crude oil, how effective Fibonacci is. Price reaches Fibonacci support, the triggers don't break, and there's a giant untradeable bounce if you thought you were going to go long. Mid-band holds. Large triggers are a full bar away, and that's a termination condition and a big untradeable bounce right back to resistance. And the triggers remain below, and another big untradeable reversal all the way down to Fibonacci support, all the way back to Fibonacci resistance. And guys, this repeats itself every day. And you know where these areas are long before you ever get to them. And the hardest thing that you will ever do is choose not to trade into them. Guys, 90% of your day is spent waiting. The easiest money you'll ever make is trading away from Fibonacci to Fibonacci. And I think that's what Rob just mentioned in the room. A lot less anxiety, not trading into areas, trading from a blue to a red, trading from a red to a blue. And when you've got momentum, it becomes pretty effortless. So price reaches an area, where are my triggers? Your triggers define your termination. If a termination condition reverses the market, whether it's large triggers going from green to red or large triggers going from red to green, if a termination reverses the market, We call that a strong top or a strong bottom. And a strong top or bottom is that best of the best. It's the precursor to the highest probability trend trade you could ever take. It's also rule number one for that second trade that you're going to get on the plan that I give you. It's also rule number one when you start going back to the other trades that Nexgen teaches. When you talk about high volume area trades, momentum trades, that strong top or bottom is rule number one. So learn it. And then if it breaks, here's what it looks like as an area breaks. And you'll never know if it's going to break. Yeah, I messed it up yesterday, Andy. So Wayne's just ribbing me a little bit. I forgot to hit go live yesterday on the feed. That was totally my bad. So let's go through an area breaking. And what this is also going to do is this is going to kind of cement the looks that you're looking for. So number one here is price reaches the area and the triggers are still below and it's a termination. And guys, every time you hit a line, it'll be a termination condition, at least for a moment. And then if it's going to break, it's going to look like this. So first, it's a termination. The highest chance of success, longevity in the markets, dictates that you wait to see what the reaction is. Remember, the trigger lines are telling the story. We're done with price. If your small triggers absolutely smash through the area, but the large triggers remain below, as long as you have strong triggers, as long as the scissors are open, that Fibonacci area has the potential to break. But we don't consider an area broken. We don't consider the path to be clear until both small and large triggers get above resistance. Once small and large triggers get above resistance, resistance behaves as support. Your path is now clear, and your path actually remains clear until you reach the next area. And once you reach the next area, we're right back to number one. And we're going to sit and wait for the reaction. When the market's trending down, price reaches Fibonacci support, you ask yourself, where are my triggers? The triggers, both small and large, are above support. And the longevity, keeping yourself from taking avoidable losses, means that you're going to wait for the reaction rather than try to predict it. If your small triggers absolutely smash through the area, but the large triggers haven't made it through, as long as momentum is present, it has the potential to break, but it's only potential. You'll have to manage assertively if you choose to take a trade. This 50% through, 50% not, this is the second trade in the plan that I'm going to give you. And only when both small and large triggers are below support do we consider support to be broken. Do we consider the path to be clear? And with that level of momentum, I'll be looking for an entry. You'll find that support behaves as resistance when it breaks. So for the brand new user, learn the difference between a termination, learn the language that defines it, and a clear path. Learn the language that defines it. And it'll open up the door for that second trade, for that 50-50 trade. And once again, we're going to go back to the live market, and I want you guys to just see termination and termination. And then when support breaks, small and large get below, it behaves as resistance, and the path remains clear until the next line, at which point you start again. Price reaches support, even with momentum. The triggers remain above, absolutely no trades. The market comes up. It has the potential to break that key area, but it doesn't. And then it heads down. And you see this all day long. There's that potential to break and maybe a possible entry. Once small and large get above, resistance becomes support, and you're clear to the next area. Is everybody good with that? Price reaches an area if the triggers don't break it. If the triggers remain above support or below resistance, it's okay to sit on your hands. That's the most important lesson. This is the most broken rule, because that's the rule that's going to force you into that patience, guys. When price reaches Fibonacci support and the triggers remain above, it says don't go short into that area. It doesn't say go long, right, Todd? Because everything's down and everything's down strong. You're just going to wait for the reaction. Best lesson I could ever give you guys in this room. There will be times when it's area after area after area. There will be times where you can't get that clear path because the areas are stacked a bit. And this is 90% of your day, guys. This is truthfully 90% of your day. 90% of your day is sitting on your hands doing nothing, waiting for the advantages. 10% is trading, but it's okay because the futures markets, guys, the S&P market trades on average $173 million is exchanged every day. Your job is to find 400 of it. 400 in between fibs with momentum. Get in, get out, and call it a day, guys. That puts you in a six-figure income. You don't have to be in every move. You don't have to be the first one in. You don't have to be the last one out. And your highest chance of success comes from having momentum and path. And you'll find a way to get paid. Is everybody good with that? Can you give me a why, please? Price reaches support. Triggers don't break, right? We're right at support. Triggers are still above, guys. This is your wait a second look. It could break. It could bounce. It could reverse. They could fight. I don't know what it's going to be. But my rules say absolutely no trades. Let's talk about one more termination. And the termination is true on any time frame, whether it's a big chart or a little chart. 3 divergences in the same price range can terminate a trend. When it happens on a large chart, it takes a while. But man, 3 divergences in the same price range on the large chart, very often you can anticipate larger moves the other direction if your rules are met. But 3 divergences on a small chart happens inside of that one bar very often. And this is your small chart giving a heads up. It's saying, hey, guess what? We're losing momentum. We're losing it multiple times. Things could be changing even though the large chart has momentum down. 3 divergences in the same price range on the small chart is the only termination condition on a small chart. Not only is it a reason not to look for the next short trade, but it's also a great reason to exit a trade that you may be in because change may be coming. And now we're going to define entries, guys. This is where the magic happens. This is the good stuff. But I'm only going to define an entry if my large chart has strong triggers. And if I've coupled that advantage of momentum with a clear path, because with momentum and path, I have a market where the odds are favorable for it to continue in the direction of the trend, and there's absolutely nothing in the way to create a bounce. And once I do that, my entry comes from the small chart. And it is so precise that I'm going to use a limit order to buy or sell a pullback, that fight from the small crowd. And I'm going to do it at areas. I'm going to use fibs, mid-bands, or yellow 1-to-1s because the same way they can create a bounce on a large chart, they can create a bounce on a small chart. But here's the kicker, guys. Those areas are going to be inside of triggers because trigger lines are going to define where that fight is most likely to go, where that retracement is most likely to go, where that pullback, where those down bars are most likely to go. Price returns to large triggers, guys. It happens all day long. It happens on a large chart. It happens on a small chart. So on your small chart, you're going to have the large triggers that are native. The 5-1 is the small chart. And these smooth large triggers, guys, you're going to use them with the small to define momentum. When the scissors are open, you have momentum. Your entry chart will also have your 13-2 large triggers. We call them the synthetic triggers because they're from a different time frame. So anytime Nexgen pulls an indicator from a different time frame, we call it synthetic. You can have synthetic triggers. You can have synthetic fibs. But what these large and synthetic do is they define where the retracement is most likely to occur. Learn that language. Once that market starts pushing down, it may push to the top of these triggers. It may push to the bottom of these triggers. This is the most likely zone for retracement. You can increase accuracy by having those large and synthetic one on top of each other, like 2 snakes riding piggyback. And this is what we call favorable large triggers. And when I talk about the best of the best, highest probability, lowest risk entry, I'm talking about buying or selling a pullback at an area, fibs, mid-bands, or yellow 1-to-1s, inside of favorable large triggers, because this is the smallest little area where the retracement may go. And with fibs, midbands, or yellow 1-to-1s inside of it, it's the smallest little window where the market is most likely to bounce and continue with the trend. So favorable large triggers creates the most accuracy, the smallest window of opportunity. You will find opportunities here, but the risk will be a little higher and the accuracy will be decreased just a little bit. So when the large chart rules are met, we're going through it, we're defining entries, we're going through it step by step to pinpoint where the market is most likely to continue with the underlying trend. The rules are met on the large chart. So in this instance, the large chart has odds favorable momentum. The large chart has nothing between it and the targets. And the small chart is screaming up. And I'm going to look to the small chart for an entry. And the first thing that I need, the first step in identifying an entry is a reversal bar. And the reversal bar is that visual that the pullback has begun, that the small crowd has begun to fight. So I have to define where those down bars most likely to go. And price tends to return to the large triggers. And I have large triggers, and I have synthetic triggers. So I'm going to draw a box, whether it's mentally in my head or whether I actually grab that drawing tool and do it, from the highest line of the large and synthetic to the lowest line of the large and synthetic. This is showing me where the market is most likely to retrace, where those down bars are most likely to go down. And the tighter these are, the more accuracy there is. Is everybody with me? The reversal bar starts the process. It's not your entry. And then you're going to define where those down bars are most likely to go. And you're going to use the large and synthetic triggers for that. And then we're going to make that big white box smaller. And we're going to put it around the areas inside of that retracement zone, inside of triggers. And this box from 73.13 to 73.11, it's a 2-tick box. Fibs, midbands, or yellow 1-to-1s inside of triggers. You're going to create a window from the highest level to the lowest level. This is where the market is most likely to bounce and continue with the uptrend. Where the market is most likely to bounce and continue with the momentum that's going up. Where the market is most likely to bounce and continue the uptrend with the momentum and absolutely nothing in the way. Guys, you're going to learn to trust this. You're going to learn to recognize this. And you're going to have so much confidence in this pattern that you'll activate a limit order, a tick or two above the highest point of support. Not at the lowest point. We're not going to stumble over a few pennies to try to save dollars, guys. Remember, the large chart is roaring to the upside with nothing in the way. We're going to try and catch this move just above the highest point of support inside of triggers. And once you activate that limit order, there's nothing to do. You're powerless. You don't get a vote. Your opinion means nothing. The market doesn't care about it. But if the small crowd pushes down and hits that entry, guys, you're in a long position. You're in the best, highest probability long position you could ever take. Because not only do you have odds favorable momentum, that you have an absolute clear path, and you've entered where the market is most likely to bounce. And guys, this is a pattern that typically wins 70 to 80% of the time. This is the pattern that you have to learn, commit to memory, so that you can give yourself the least amount of risk, so you can give yourself the most room back to your profit targets. So we're going to go through it again for both longs and shorts. Reversal bar begins the pullback. It's not your entry. You're going to define where the pullback is most likely to go, and that's the large and synthetic triggers. It's not your entry. You're going to define where the market is most likely to bounce, from the highest point to the lowest point inside of triggers, the areas. This blue shaded area is your window of opportunity. Somewhere within this window, the market is most likely to bounce and continue in the direction of the trend. But because you don't want to miss this trade, you're going to activate a limit order just above the highest point. And because your rules define where the market is most likely to retrace, because your rules define where the market is most likely to bounce, you begin to understand that any line beyond those triggers, beyond the retracement zone, beyond the bouncy points, guys, this is the wrong side of the triggers. This is where the advantage of rule number 3 is no longer in place. Any line below the triggers for a long trade is where the market shouldn't go. This is not a part of your window, not a part of your entry equation. Reversal bar begins the pullback, not my entry. Triggers define where that pullback is most likely to go, not my entry. It's the areas inside. It's the fibs, mid-bands, or yellow 1-to-1s inside of those triggers. This defines where the market is most likely to bounce and continue down. I'm going to activate my limit order just below it and hope the small crowd gets me. Any area, any fib, any mid-band, any yellow 1-to-1 that is sitting beyond the retracement zone, beyond the areas most likely to create a bounce, this is not a part of my window, not a part of my entry. This is the wrong side of the triggers and where the market should not go. Once you get beyond your advantages, you don't know if or when that market's going to go down. And you're going to use this concept. You're going to use the idea that with 3 rules, you can define where the market is most likely to continue. It allows you to define where the market shouldn't go. And initial stops, ladies and gentlemen, will be placed beyond those trigger lines, about 4 to 5 ticks. And you're going to say to yourself, I have every advantage I look for to trade a pattern that has been proven to win more than it loses. This is where my advantage from rule number 3 is no longer in play. This is where I will choose to exit this trade if they can push through all of those advantage-giving things, the retracement zone, the areas inside. And here's the kicker, and this bugs the hell out of new users. It's going to hit that area. It's going to hit your stop, guys. Anything that wins 8 out of 10 times has to lose 2 out of 10. It's just math. But this is what we call an acceptable loss, and this is a cost of doing business. And small losses are a normal part of a positive equity curve. So your ability to pinpoint entries gets you set up for management. And here's those tails. Here's how you're going to study this. And here's the great thing, guys. You don't have to put the pressure of trading on you to recognize this pattern. You don't have to get in and out of the market to recognize this pattern. I want you to try it, but I also want you to take time. So I want you to scroll back on a large chart, and when you have momentum and you have a clear path, or at least the potential to break, I want you to circle those tails if you see them. And remember, we don't trade tails on the large chart. We trade areas inside of triggers on the small chart. And if that tail, the circle you put on it, lines up with an area inside of triggers, this is your pattern. This is a high probability trend trade. This is what you're committing to memory. And here's the cool thing, guys, is even when the market is all the way up here and you're waiting for a reversal bar, you're going to know exactly where your entry's coming from because it's nothing more than a pattern. When it's running up, you're going to be hoping for a reversal bar. And when that reversal bar prints, you're going to know exactly where your entry is going to come from. And when you take that entry, you know exactly where your stop is going to go. And guys, this is what you need to study a little bit. You need to go back on that large chart and say, all right, with all that momentum and the potential to break, the triggers have gotten through, there's one of those tails. Let me circle it. And if I go to my small chart, and this is crude oil, guys. This is live. This is what, 10 minutes ago? It pulls right back to that mid-band, right in the retracement zone. Do you guys see it? The small chart looks like a termination condition. The large chart has the potential to break. That's why we let the large chart lead the way. Bigger bars, bigger moving averages. There's your retracement, right back to the mid-band, continuation with the momentum. Can you guys give me a Y if you see it? Sometimes it's directly into a termination condition. But the pattern still repeats, guys. This is the pattern that we're looking for. Looks like that one had the potential to break. That one right there hadn't reached the area yet. That was momentum and a clear path. And what did it look like? Come on. Ooh, maybe not. Probably not our entry. So sometimes you'll circle a tail and you say, wait a minute, that's not inside a favorable. Oh, hold it, it is. But maybe it didn't get to the mid-band. Maybe that's not my trade. Maybe that's not the best of the best for me. And you'll scroll back and you'll do this, guys. You can do this without ever taking a trade. You can take 20 minutes out of your day. and say, I'm going to look for that great large chart look because the large chart leads the way. And if I have it, I'm going to see how it looked on the small chart. And let's see, I thought I had the S&P up. I don't. So I'm going to open up my S&P. This is my first hour every day, guys. And now I'm going to give you, I always promise you guys, everything you need to be successful with the software. Good morning, Marky Mark. So there's a zip file that I just dropped into the chat room. Please download it, put it on your computer. Inside of that zip file, you're going to find a couple different goodies. The first one is Chart Reading 101. And again, you're going to hear me say a lot, the easiest path to becoming a confident trader isn't necessarily taking trades for the first week. I want you to, but I want you to take more pictures than trades, guys. The goal is that you learn this core advantages, that you look to the large chart first, that you identify momentum, that you define your path. And once you have those two concepts down, it opens all the doors, guys. So go take 25 pictures of strong triggers for me. And when you take that picture, take the time to annotate. I want you to use words like smalls above large, space between, scissors open, odds favorable momentum. And I want you to define it. And you're going to define it not only in the picture that you take, but also in the words that you use to describe it. And if you do that for strong triggers and weak triggers, 25 each, it's only 50 pictures, guys. It'll take you, I don't know, an hour. You're never going to make the mistake. You're never going to say, oh, I thought my triggers were strong, when you know that they're weak, because repetition, doing that, creates the recognition. Do it with a clear path and a termination condition, guys. Post these pictures in your spreadsheet. And what you'll find is that strong triggers becomes pretty easy to identify. Smalls inside weak, no momentum. Rule number 1 not met. Strong, separation, colors match, odds favorable. Rule number 1 met. So there it is. What it means to have it, what it means to have it gone. Guys, and this recognition is going to set you up for finding the next trade. So go through this. I've never had anyone do this, walk away from it, and be sad that they spent the time to commit these looks to memory. As you go through and take the pictures, you can use the high probability trend trade checklist to make sure you're taking the correct pictures. This is just a checklist for entry, guys, to get you into the highest probability, best of the best, just the greatest way you could ever take this trade. It starts from a strong top or bottom. You can take it without a strong top or bottom. It just adds warm fuzzies if you have it. And that means that it's a no triggers through termination that reverses the market. I define everything. A no triggers through termination that reverses the market. Now it's a strong top. No triggers through termination that reverses the market. Now it's a strong bottom. The best of the best, highest probability, rainbows and sunshine, is to have odds favorable momentum on both of your charts, to have separation on both charts. Strong triggers, odds favorable, likely to continue in the direction of the trend. You have to know that you're not trading into a termination condition. You've got to have a clear path. And then defining your entry all the way down to where you're going to put your limit order. Guys, everything here is visual. The second one is just something to print out and put on your desktop. So as you go through and you start taking these trades, have your checklist. Hold yourself accountable. And even if you make mistakes, that's okay. You know what you're looking for. And if you write these rules on a chart every time you take a picture, what you're doing is you're learning how to police yourself. You're learning how to make sure that you're giving yourself the highest chance of success. If you're using market replay, you can actually pause the market and double check your rules and see the potential of this very simple plan without ever even having to enter a live market. And when we talk plan, one of the most profound things, one of the most intelligent, the most impactful things I ever heard from a professional day trader, from somebody that does this every day, and this is their job, was that you have to have a plan. You have to have a written plan. And that plan has to be specific, it has to be testable, it has to be repeatable, and you have to commit. Because the commitment helps create the expectations, guys. So this is your KISS plan. I'm going to drop this in your hot little hand. It's in that zip file. This is a stepping stone in your learning journey, guys. The high probability trend trade doesn't have to be your only trade if you don't want it to be, but this is the highest chance of success. This plan optimizes your chances of success. It creates confidence. And then through simulation, through study, through class feedback, and continuous practice, guys, you'll be able to write your own plan. You'll be able to change up your management. Guys, is it just Andy getting bad volume, or is it everybody? Can you hear me okay? Am I coming through clear? We're good? It might be Andy. So there's two things that you need to know before you sit down and you're not on simulator. If you're on simulator, guys, I want you to be okay with making mistakes. You have to know why you'll enter a trade. And the generic, the best answer is, I'm going to enter a trade because my rules are met. It's the only reason that I'll enter a trade. And my rules describe a pattern, guys. We've just spent an hour describing the pattern, the individual parts to piece it together to create a trade. And you have to prove that it wins more than it loses. And guys, I'm about as trustworthy as they come. I don't want you to believe me. I want you to go back and circle tails. I want you to test this pattern. I want you to prove to yourself that it wins more than it loses. Because if you do that work, one, you'll never miss an entry. But two, you're stuck with me for the duration, guys. If you come at this and you prove that it works to yourself, not just believing me, you'll know the potential is there and you'll never leave Nexgen. And we've got people that have been with us for 20 plus years. The rules also help remove emotion because your rules have been proven to win more than they lose. You know that you're going to win more than you lose if you just follow your rules. And that understanding and that trust keeps you committed to the best of the best. You also have to know why you're going to exit. And this is where emotions flood new users. Guys, exits are either taken at profit targets, and your profit targets are either predetermined or are key areas. And the only other reason to exit is because you lose the advantages that got you into the trade. You've got to be out by 11 Eastern. Yeah, Wayne, I'll get you. No worries. So when your advantages go away, so do you, right? So if you enter at the area inside of favorable large triggers and it goes 4 to 5 ticks beyond, you choose to exit because your advantage is gone. If you get into the high probability trend trade and 3 divergences print, you choose to exit because your advantage is gone. But in the beginning, I don't even want you to think that much. I want you to define your entry, to be able to get in at the best of the best spot. And then you're going to learn how to manage it in the most mechanical way I could ever write, guys. The KISS management plan is if-then. It is super basic. And if, as you're learning these entries, you allow your management to be this pragmatic and this emotionless, you're going to learn a lot of things. It's based on 2 contracts, and it's designed to help you understand stop placement first. But it's also focused on getting you paid. Because somewhere in the excitement of learning to be a day trader, we forget that the goal is to get paid. So this keeps you focused on it. And then you'll create your own management plan. You will. You'll come up with a way to manage that is outside of this. But you're going to do it when you're good at reading your indicators, when you can recognize things changing a little quicker. So the KISS plan, 2 contracts, 1 entry is 2 ticks below the area inside of triggers. Initial stop is 4 to 5 ticks beyond the triggers. This is where the market shouldn't go. And you'll know your risk before you ever enter a trade. You'll know exactly where your stop goes before it ever hits your limit order. And you have to accept that. You have to accept that risk. And if you don't, it's okay to not take the trade. That's your right. Targets are predefined at $100 and $200. Remember, we're learning how to get paid. So if they don't hit my stop, then a reversal bar prints. And the reversal bar says, hey, guess what? We're going down with all those advantages. And you're going to redefine where the market should not go, guys. Let it be if-then. Don't try to anticipate reversal bars, right, guys? How many times do I see you get in at the bottom of this bar thinking it's a confirmation bar when it hasn't printed yet? Let it print. And when it prints, redefine where the market shouldn't go. 2 ticks above it. And now you're sitting on your hands, guys. Your initial risk was $150 per contract. Now you have $30 of risk per contract. And it doesn't guarantee a winner. It just guarantees a smaller loser. And if they don't hit that stop, You're going to hit your first target, which is only $100 away from your amazing entry, guys. And this is where confidence comes from. The first target is designed to get you paid, to feel good, to dry up sweaty palms, and you're going to move to break even. So not only did you get paid and that money goes in the account, you have absolutely nothing to lose in this trade. You can't do worse than $100. And that is what the second contract is designed for. It's designed to get you trusting the idea that with momentum and a clear path on a big, slow chart, that the market is more likely to go down than it is to arbitrarily reverse and go up. So you're building trust with no risk to get to the second target. And if they hit the second target, congratulations. It's a $300 trade, guys. That's $200 on the second, $100 on the first, $300. And a lot of people, they're not cool with $300. Man, that's only $300, Mark. Guys, that was 3 minutes of your life, start to finish. $300, if that's the best you do every day, that's a $75,000 year based on 252 trading days a year. Throw in another trade, capture 400. Guys, you're in six figures. And you can accomplish this. Guys, you have the potential to accomplish this with nothing more than a high probability trend trade. Some days you may make 700 or 800. Some days you might only make 200 because the market isn't giving. But every time you enter the market, you know you have the highest chance of success. You know you've got the best of the best. You know you have a pattern that's been proven to win more than it loses. And all you have to do is learn that pattern as a brand new user. Take the time to study it so that you can trust it. I'm dropping that everything you need zip file in there again. Inside of that file is Chart Reading 101, learning how to read the basic core advantages. Inside of that file is the high probability trend trade checklist with the pictures showing you what it looks like to have your rules met. Inside of that file is the KISS plan, optimizing your chances of success with the high probability trend trade, and then moving you to that potential to break trade with different rules and different management that depend on your ability to understand the high probability trend trade. Inside of that zip file is also the PowerPoint that I use to teach the classroom every day. And inside of that zip file, finally, is Trend Trade Simple file, guys. And this is everything that we've just talked about, start to finish, consolidated into 2 pages, a quick reference guide with every picture and the whys, because I'm a big fan of the whys. So that's our first hour. That's the first part of class. And the second part is 100% feedback, guys. It's 100% feedback on the pictures you post. It's 100% feedback on the questions you ask. It's the interactive part. It's the discussion part. So the more questions you ask, the better this classroom gets. But look at that. With the momentum and everything up, there's 3 divergences in the same price range. Live market lessons, guys. And the market is pushing lower. Pretty unbelievable, right? You know that lesson. You're going to study that lesson. You're going to learn to trust that lesson. And you don't have any areas inside of triggers. Double whammy. That's an avoidable loser. If you tried to go long, if you tried to impose your will on the market just whipped your ass and told you to follow your plan. I love it when it does that. I'm going to go take 5 minutes. When I come back, Wayne will do yours first. Kick you out to your doctor's appointment or whatever appointment it is. Probably massage, yoga, who knows. And then we'll get to the rest of the charts, guys. I want you to get mouthy, get talking, talk to me a bunch. Let me know what's on your mind. We're also going to go through an entry lesson today that we covered yesterday that I think was really eye-opening for a lot of people, but some Yahoo forgot to record it. So I created a PowerPoint. We're going to do an entry lesson too. I'll be back in about 5 minutes, guys. Go stretch your legs. I'm back. Let me click on all of Wayne's. Joel asks, is there any time divergence can be ignored? So Joel, I think that the best answer for that one is, if I have odds favorable momentum on a large chart, if I have a clear path on a large chart, it takes 3 divergences to keep me from taking an entry. So I can ignore up to 2 divergences. Does that make sense? That's when I could ignore it. Yeah. All right, Wayne, let's go through. Thank you for putting those all in one spot for me. I loved this one when I saw it. So guys, there's a pattern. Everybody knows, you're welcome, Joel. Everybody knows, because you talked about entries, that price tends to return to the large triggers. And guys, when price reaches a mid-band, especially when it's not a strong top, and those large triggers are a full bar away, this is what we call the gap theory. This is what defines. This mid-band is a termination condition, and because of the trigger location, this is a look where the market is more likely to close that gap back to those large triggers than it is to continue down, especially if it's not coming from a termination condition. Wayne takes that. Wayne gets an up bar and says, I'm going to close that gap. And sure enough, he does. Off the market goes. It's doing exactly what the pattern says, and then it reaches that gap theory. And now here's where, before we get to the next picture, spoiler alert, guys, when you get back up to these triggers, it doesn't mean go short, because it's a termination condition. It's a termination condition. It's a termination condition. Just because it closes the gap doesn't mean that it's going to go back down. And very often from a bad top, when it's not coming from a termination condition, you see the same thing right here. Here's the same pattern. Very often you get continuation up. And I say that, Wayne, because your short entry is not a momentum entry. You took the short. So it's not a momentum entry. It fights up triggers on the large chart. It fights it fights the momentum on the range chart. It fights the momentum on the small chart. Wayne, your momentum trade would have been down up and going long with all. It says short entry, and then it says you got stopped out. That was definitely not a long. That was a short that lost. Were you trying to go long? Yeah, long makes sense perfectly. Short is the opposite of everything good. So good. That was just a mistake. But yeah, you went short against everything. So if we pretend that's a long, it's the perfect trade, Wayne. But the short was a whoops, a mistake. I just assumed you tried to take your heartburn trade and got run over. Oh, is that what it is? Right on. Then that was a good one, man. And then here, odds favorable, potential to break. It pulls back to an area inside of triggers, you didn't take it. It pulls back to an area inside of triggers, you didn't take it. And Wayne, this is where I like it. You get the white bar here. And I love that you labeled it my MF white bar, because you know what I hear. This was just a 50-50 trade that was perfect from the mid-band. You're actually pretty late, because you skipped the rules for the perfect 50-50 and you turned it into a different trade, and it put you in pretty late. Does that make sense? It's 50-50. Smalls have smashed, larger above, momentum is strong, no divergence, perfect entry. This was that potential to break look. Does that make sense? Right on. And then I don't know how that's relevant, because you still traded directly into both of them. So And then you just ride that momentum down, which is cool. I just think you probably could have taken it up there, managed at the treble, um, but still a great trade, dude. You're going with momentum, you're going with path, and it's hard not to win when there's momentum and nothing in the way. It's hard not to win, and you do it again. Just quick little payday before trouble. Almost surprised that you didn't take it at the HVA. I know you love that look, but this is great. Large chart leads the way, guys. When you have momentum and nothing in the way, you're gonna find a way to capitalize. You're gonna find a way to make money. Great job again, Wayne. And now this isn't the best momentum, but it is a clear path. And there's that HVA trade that you like. Using a range chart, just a little extra information to help out. And it coincides with the mid-band, and you catch it on the way up because it's the wrong side of the triggers. And again, another easy money. Large chart leads the way. Now this one's a little different, right? So this isn't a trend trade. So you new users, this is a trade that you're going to learn as you grow with the software. And it starts with a strong bottom. It starts with a no triggers through termination. And then things roll on a small chart. Things roll on your small charts. And this green line, this is the HVA. He calls it the HVA trade. This green line off that termination condition is where collectively the buyers got together and said, to hell with the sellers, we don't want it to go down anymore. And then you have a chart that's available to you that prints that green line. This is the market flow chart, guys, and it's a little advanced. You've got to understand some basic concepts because the large chart looks ridiculous. But when this termination rolls the small triggers, there's your pullback right to the small triggers. And what's cool, and Wayne, this is perfect execution on an HVA. Your target should be this 1-to-1. You can definitely get more money on this trade. Your target is the first sign of trouble, large chart. Because of the termination, because of this, you had a lot of money to be made on this one, but that's okay. As you grow into these, you'll get better at collecting more. I love this trade because this trade, Nexgen started teaching in 2004. Termination, Fibonacci area, small triggers roll, small triggers roll. Here he bought the pullback to the small triggers. In 2004, this particular trade shows you selling the pullback to the small triggers. So when I talk about the market repeats itself, here's Wayne's trade this morning in 2025. Here's Nexgen teaching the exact same look in 2005. 2 decades later, the patterns still repeat. I'm not sure I could find a better example to remind you to learn the patterns. Beautiful trade, Wayne. Does that make sense on the potential for a little more profit? So on the HVA trades, I'm always looking for that first area because, man, it's such a good look. And then high probability trend trade F gap. Let's see what you did. So you try the first short from the wrong side of the triggers. Great lesson. I love that. Yeah, that's preset. So here you had momentum. Here you had path. You did have an area inside. That would have been an acceptable loser, and it didn't work out. And then it pulls up to resistance, and the large triggers are a full bar away. There's that gap theory again. Wayne goes short, not fighting the momentum, rides it down to the gap. And Wayne, excellent pattern recognition. If price reaches a Fibonacci area and the large triggers are a full bar away, it's more likely to close the gap, especially from a bad bottom. And Wayne, you just absolutely nailed it. And this trade, this is pretty cool, guys. I want you to see his trade to close the gap. Looks exactly like this trade up to close the gap. Once you learn patterns, you're going to find a way to capitalize. Everything says up, momentum is up, absolutely no terminations, and Wayne goes short. And this is another great example that guys, you'll find ways to make money. And I'm obligated to say, Wayne, this fights everything, right? This fights everything. But Wayne's recognized a pattern with a third chart that says, man, if this happens, no, it does. It fights everything. Odds favorable up, odds favorable up, odds favorable up, every trigger up, every trigger up, every trigger up. It fights everything. There's one little thing in there that tells Wayne he's willing to take a shot. Yeah, but you didn't even wait for that. Oh, a line here. And what Wayne's doing is he's trading the pullback to the trend trade. Is what it is. And it's aggressive. It's aggressive. I don't mind saying it, Wayne. I'm not afraid to hurt your feelings. You know it's aggressive. But it's a pattern. And it's a pattern that he's studied, and I know how much time he's put into studying it. And he's comfortable with it. I couldn't bring myself to pull the trigger on that. Wayne has absolutely no hesitation, because I guarantee Wayne has at least 150 pictures of that exact pattern producing results. Wayne, great trading this morning, man. Great trading. Thank you for posting. I hope you get to your appointment on time. Good stuff. One, two, three, four, five, six. All right, it's the Pete Show. And guys, I don't mind. I don't mind if you post a lot. Absolutely. The only one that I could even point out was where you accidentally went short not long. But you had the exact right idea. All right, guys. Pete putting on a clinic this morning. There's that same gap theory trade, guys. Price reaches a mid-band, reaches resistance. All the triggers remain like larger, a full bar away. And Pete goes short. First, he gets the divergence. He confirms that resistance, that there's a loss of momentum, and then he gets in and just rides it all the way down. Absolutely perfect. You and Wayne are in cahoots. And guys, that's on different markets. Wayne did it on gold twice. Pete just did it on crude oil. Patterns repeat themselves. Here, everything is screaming down from a strong top. Pete says, let it get below anything that could create a bounce, and I'll find a way to make a couple $100. Perfect execution, Pete. Once you have momentum and path, guys, you'll find a way. A little jumpy on the stop out. I don't think you gave it enough room to breathe. Everything says down. There's nothing in the way. The momentum is strong. And Pete, I think you just kind of stepped on your own toes a little bit there. It's just too tight. You're not even giving it a chance to do anything. Yeah, I think so. But it's with momentum and path, it went down right to the fib. Great exit on the second run. Momentum and path, momentum and path. Absolutely beautiful. And then Pete takes one into the termination condition, and that's his right. It's his right to trade into a termination condition, but he doesn't jump in arbitrarily. He says, with this look, I'll get in, and with the momentum, I'll see if they retest. And they did. And he caught it. Nice job, Pete. And then once again, strong trending market, nothing in the way. Pete says, I'm going to jump in and get out. And I'm going to make money. Because when I've got a market that is screaming in one direction and there's nothing to create a bounce, I'm going to find a way to get paid. And Pete, absolute clinic. Here it is again. Everything says up. The potential for it to break is there. Pete says, let me take that Nexgen momentum trade. Let it break above trouble, and then I'll just trade from trouble to the next trouble. And once again, Pete, this is probably some of the most conservative trading I've seen out of you in a while. Oh, did you really? That's cool. That's pretty awesome. Doubling up the research team. And it's paying off, Pete? So can I rephrase that for everybody listening in the room? Pete is taking a more conservative approach to trading the market, and it's paying off. And he says actually like he's surprised. Like when people tell me, wow, Mark, you're actually pretty smart. It means you didn't believe it in the first place. But Pete, I love seeing that. I love seeing that you're showing the world, man, you don't have to be aggressive to make money. You don't have to trade into areas to make money. You don't have to fight momentum to make money, guys. Embrace momentum and path and find a way. And then Bob comes in and says, check it out. The first one, I've got room to trouble. I'll make a little money. And the second one, well, I don't have any room to trouble. It's directly into a termination condition, but with this much momentum on the small chart, I'm going to hope it retests. And it sure enough did. And you'll notice that he gets out before trouble. Guys, when you know what you're up against, you'll know to manage assertively. And Bob, first one, beautiful, awesome, high probability. Second one, still has momentum, still has an entry, medium probability, and you manage assertively. Really nicely done, Bob. And then Cav, momentum. When there's momentum and nothing in the way, you're going to find a way, guys. And that's exactly what he did. And that's not a bad morning. 2,400. I'd be okay with that. I could swing golf clubs on that kind of money. And again, momentum, he lets it get below the trouble, carries it down. I don't understand your stop even a little bit, or your target, because you take profits as it's coming down with momentum and path. You took profits right at the best, juiciest spot of a trend trade. And that's the one, at this point, you could have held that one to the fib, Cav. That's getting caught up in the moment a little bit. Awesome, Wayne. You found there is a sweet spot. Good stuff, man. Have a great day. Does that make sense, Cav? Everything is down. The momentum is okay. You've got room to the targets. You already pulled back. You already bounced. You already headed down, and then you took an exit. It hit your target. So why didn't it hit your target here? At the same price over here? That would be my question. Maybe it was just moving too fast. Yeah, because the timestamp suggests it was probably just moving too fast. Because that's right when news printed. So you didn't have time. So it probably hit it, retraced, came down, and you got lucky that it went back down during news. That makes sense now. Thank you for that. Sometimes I need you guys to point stuff out. Cav. Not odds favorable, but definitely a clear path. Clearly defined entry. 2 out of 3, easy money. Nice job, Cav. 2 out of 3 makes it medium probability. Medium probability isn't a deal breaker. Well, Cav, that was because you traded right into high impact news and NinjaTrader couldn't fill your orders fast enough. If it had spiked up from there, you would have been slipped a lot of money. You got lucky that it went back down. That's that trading during news. Everything says down with momentum and Cav just jumps in and rides that wave. Nicely done. Trading right after news, riding that momentum wave. Everything says down with momentum and the path is clear. And Cav takes an entry, trend trade entry, and makes money again. Great job, Cav. You're making it look boring. Momentum, everything says up, pull back to an area inside of favorable large triggers, and I'll be damned it goes up. Everything, well, there's a termination, there's the roll by the pullback to the small triggers. Looks like a pullback to the large triggers. Cav, this is that one you showed the other day too. It's not quite a trend trade because one synthetic is down and your large are up. This is that termination, the small triggers roll, and a beautiful buy to take it up. Really nice job. That's that edge trade. That's that same one that we started teaching in 2024. Great stuff, dude. Really, really great trading. And I went a little quicker on Cavs. Cav knows it's great trading. Cav's showing you guys what can be done when you have a plan. And Rob, we're getting close to you, brother. Miss Jen. Strong top. Odds favorable. Back of the bar clears the decision-making zone. Jen jumps in, jumps out, makes money. Absolutely beautiful, guys. This is what we call the chili dog. Taking advantage of momentum and path, finding a way to get paid. Finding a way. Everything says down. There's absolutely nothing in the way. Jen says, watch this. Whee! I'm going to ride that wave all the way down to the fib. Absolutely beautiful. So I'm going to pause for a second, and I'm going to ask you newer folks, Todd and Bejoy and Sitboy and Aaron, if you get nothing else out of this classroom today, when every indicator is screaming in the direction of the trend and there's absolutely nothing in the way, I want you to believe that you will find a way to capitalize. The high probability trend trade teaches you to embrace these advantages. Your entries will change as you grow with the software, and that's what you're seeing this morning. You're seeing people take those core advantages, those advantages that I stress over and over and over, and turn them into trades, turn them into beautiful trades that aren't high probability trend trades. All right, Cav again. There's the termination. The gap theory closes the gap to the large triggers, and with every indicator up, in a little bit early, and out at trouble. Nice one, Cav. Taking advantage of termination conditions. Everything is down with a clear path. You take the entry, and you make money. I mean, my goodness. My goodness. Momentum and path, momentum and path, momentum and path. Momentum and path. Have I mentioned momentum and path? Broken record, ladies and gentlemen. That's what I do. I say the same stuff until you believe it. Say the same thing every day. The same looks every day. The same rules every day. Until it sticks. Until you're like, oh my gosh, I can't wait to take a trade with momentum and path. This looks pretty awesome. No worries. And Todd, we talked about your trade from yesterday already, didn't we? You fought everything and got lucky. The trend was down, you went up. The triggers were down, you went up. So we'll talk about entries. We'll get you on that one because I know that's what you're practicing. Keep doing that. Did you miss? Oh, yeah, you were so lucky. So lucky. You swam through a river of crocodiles and they were all distracted with a gazelle. You got lucky. All right, triggers are breaking up. They didn't break the fib. This is a loss of momentum, and this is the potential to break. But what Cav notices is 3 divergences in the same price range, and every indicator's up, and he can define, well, it's not even inside. Well, it is. He's got the fib that he's hoping will break inside of the triggers, and Cav, you might have pulled one off there. You might have gotten a little lucky on this one. Because that's weakness, potential to break. You've already had the 3 divergences. Maybe a little luck on that one. And then it's just easy. Odds favorable, clear path, perfect entry. What's funny though, and guys, I'm going to show you this, and Cav, please accept it with the love that's intended. That one that was lucky, Cav holds that mother scratcher forever. The one that's perfect, he takes a quick little exit. Once you know your rules, you know when you're breaking them, right, Cav? And if you already break them and you already are relying on that hope, guys, you start hoping that shit just goes even further. You start hoping those trades last even longer. You hope those profits get even bigger. And then when it's perfect, you cut it short for unknown reasons. Welcome to the human mind. Great trading, Cav. Great trading. Cav putting on a clinic of what can be done. All right, Rob, are you ready? Let me know you're in here. Let me know you're in here, Rob. Tried to catch a pick and finally got a pick in between red and blue lines. Had to move stops to catch $20 move instead of a $15 move. Was confident the move would come back, and it did, as noted by the blue target arrow. Okay, so Rob, you didn't have momentum, but you had a clear path, and you sold. And then you still didn't have momentum, and here you bought, so it looks like you were stopped out of this trade. I can't see your contracts. So there's your entry, and there's your exit. Where's your was there a second entry, or was that two contracts? Okay, then how did you have two exits? I see an entry, and I see an exit, and then I see a second exit. So I don't even know what time frames these are, Rob. So we're going to do this. Everything says down. You went down with it. Cool. Divergence prints, so there's no more momentum, and it looks like you take an exit, but you don't. And then a second higher divergence prints, and your triggers are rolling, and you still don't exit. And your triggers roll and go up, and the trend changes, and everything says up, and you still hold on to it. And then fortunately, it goes down. And Rob, you don't have small triggers on your chart. It looks like you have two sets of large triggers. And this looks like a good entry chart. So over here, where everything finally agrees again and you get a pullback right to that mid-band inside of triggers, you could have taken the exact same trade with maybe the exact same entry and taken the exact same profits without having to sit through a complete trend change and momentum up. And I'm sure you have a plan, but I don't understand it. And I can't for the life of me figure out why you would hold through all of this, but exit when everything finally agrees with down. Does that make sense, Rob? Everything changed and you held the trade, and then when it finally got perfect, you chose to exit. Great job. I'm not sure that I can offer any feedback because I have no idea why you held that trade. I'm not sure why you entered. And I definitely don't understand your exit. So I'm going to do a lesson, Rob, and this is for everybody. Did you have rules for entry? Did you have something that says, okay, this is my entry? Or did you just jump in and hope? I'm below the fibs, I'm just going to jump in and hope that the fibs hold. And with the trigger line location, you had a fighting chance, without a doubt. I think that the challenge is, man, when everything agrees and says down, that market's more likely to head down. Okay. Well, I have lots of feedback, but I can't give it because I can't see your picks, right? I'd love to know why. And I'd love to know why you didn't go short here and take it to the fib. And then you pause, right? Great job pausing. And then you start to get below and you're like, hell yeah, let's go. And then this is where it gets a little wonky. And then when it finally goes rock star again, you're like, all right, that's enough. I'm good. I love that you got paid. Is this how you're going to get paid every day? That's the question I always ask you guys to ask yourself. Is that how I'm going to make money every day? Is holding through chin changes, hoping areas hold, is that my path for success? And if it is, man, if there's something going on there that you can repeat, that you know, I love trigger location versus the areas, then keep doing what you're doing if it's bringing you success, guys. But if you don't tell me why, and this is for everybody, not just you, Rob, if you don't tell me why, If you don't tell me what you see, if you don't tell me why you entered, if you don't tell me why you exited, it's difficult for me to give you feedback. It's difficult for me to say, hey, I see where your head's at. This makes sense. This needs a little tweaking. So don't skip out on that part. Andy, strong bottom over here. Odds favorable, potential to break. You take the entry and you get out with divergence because it's a 50-50. I like it. And these triggers are wide, which means that it may close the gap. Nicely done, Andy. Nicely done. Bob, be the man. Everything says up. Into that termination condition again. We found your thing, Bob. You love trading into lines because you trust momentum and strong bottoms. I'm not going to get you. I'm not going to yell at you. With this much momentum, Bob says it may retest. And it did. And then he trades directly into another line. With this level of momentum, it may retest. Oh, and it tried to, and then that second lower divergence takes him out. No more going long. Nice job. Bob, what you've done is you have absolutely thrown your trust in momentum. And here it is again, termination and momentum. And again, right into a termination condition. 3 for 3, Bob. 3 for 3. So much so that you've stopped mentioning it. You've stopped mentioning the termination conditions that you're trading into. I'm not going to tell you not to do it. I won't do it. I won't tell you not to do it. I refuse to tell you not to do it because I don't give trading advice. But one of the things that I love to do is see how often termination conditions stop the forward progress of the market, even with odds favorable momentum. This is something that I do every couple of days to remind myself that my advantage is gone, trading into termination conditions. And while maybe I can catch a bounce, I don't need it to be successful. And Bob, you're taking it and you're managing it, and that's all you can do. And I'm not going to tell you that it's going to bite you in the ass, but I will tell you that I had a gentleman one day, and he loved trading into termination conditions. I don't know if it was childhood issues or whatever. He loved trading into termination conditions, and he did it very much like this. And then one day he came to the room and he posted that he lost $60,000 in his account trading into termination conditions, and his luck ran out. And I'm not saying that's going to happen to you, but I am saying that rule number 2 is a rule for a reason. And guys, if you choose to trade into termination conditions, that's your business. But it's a rule because more often than not, money is lost doing it. More often than not, money is lost trading into termination conditions. And Bob, I haven't seen a loser from you since you've gone live, so I'm happy for that. You haven't posted a lost trade yet. And I hope that that's the truth, and I think that's wonderful. And I hope that path continues. You have losers? Weird, but you haven't shown me one. In the last 2 weeks, Bob, I haven't seen one loser from you. Absolutely no opportunity for me to try to help you avoid losers. If I had to guess, and tell me if I'm wrong, were your losers trading into termination conditions and you didn't want to hear it? Odds favorable, clear path, perfect entry, easy money. Cav is putting on a clinic for you guys today. Hey, I don't know if you guys noticed, but with odds favorable momentum and nothing in the way, you guys are likely to find a way to get paid. And Bob, you know I'm not busting your chops or beating you up, right? I try to be real honest with my feedback. And if I think you need, sometimes I just need to know that you know that you're trading in determination conditions. Here's a great example. I want you new users to take heed. And guys, this is an opinion trade. This trade doesn't have momentum. It does have a clear path. The entry's from the wrong side of the triggers, and it just zooms. It just absolutely zooms. Or is this it down here? 952. Oh, no, it's over here. It has momentum, and it has path, but it's entered on the wrong side of the triggers. So Cav, getting in at the area inside of triggers has a tiny little stop and probably a smaller loss. Once you're on the wrong side of the triggers, guys, there's just no telling. And then Cav, I don't know if you've ever explored it. Dude, if these small triggers are right up on you, they're going to bust your ass. If you really want to take this short from the wrong side, wait for the close on the other side, and then you've got that fighting chance coming down. Remember, this is a 13-2, Cav. This is a 13-2 chart. This is a big chart. This is a 34-5. And look at that close on the other side, and it really becomes easy because the large chart says probably more down. You'll see this a lot, and here it is there, where those small triggers behave as resistance when they're down, where they behave as support when they're up. You can use that to help fine-tune your entries a little bit. Your large chart was solid. Just on the wrong side here. Good stuff, man. Good stuff. All right, let's see where we're at. Dun, 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 dun. Cav. All right, we're going to double up on Pete. Let's see if Pete's still conservative. Whoops. Momentum. And down here, we're weakening the triggers. And here's the challenge, is you traded directly into the one-to-ones. Guys, when you're doing these jump-in trades, and I don't care if you do jump-in trades, when you have momentum and path, it's awesome. But if you don't have momentum, and you don't have momentum, and you've got things that can create a bounce, guys, that's exactly what typically happens. And that's a tough look. And then just getting in on the other side of things gives you a chance to roll down. So I know you know what you did there, but that's a great lesson. If you're just going to jump in, you're good. And why he takes a momentum style trade, exits with a loss of momentum, no reason to hope, right? And then that fib update showed up too, just to ruin your good time. Good stuff, Pete. Good stuff. Remember, guys, I'll never tell you how to trade. I'll never tell you what to do, but I'll look at your charts and I'll read them to the best of my ability. And everything says up. The momentum is waning, but you have a perfectly defined entry, and it's easy for you to make money there. And Cav, the one thing that has been consistent with you for almost every trade is momentum and path. And then taking that easily defined entry, even if it's only 2 out of 3, you're killing it today, dude. And the numbers show it. $7,500 is a pretty nice day. I think most of us could make a living on $7,500 a day. And then Pete, momentum, potential to break, perfect entry, great management on a potential to break trade. And because it's a weak bottom, I love it. When you get back up to that loss of momentum and the triggers aren't strong, you're like, that's cool. I'll take my money. Great management. Nice job, Pete. I like that one. And man, everything says up with nothing in the way. You take the entry. I don't understand your stops. Did you get stopped out inside of the triggers at the mid band? I mean, it blew lower. So this is a good example, and then Cav, this is a good one for you too, and Andy. Do you see how the small triggers are down and they behave as resistance again? And then once you get to the right side of them with this look, off it goes. For you guys trading the NASDAQ, this is one of the best rules you could ever learn. If those small triggers behave as resistance, that's where that patience piece comes in. That's where you start waiting for it to get to the other side. Good stuff. Cav Pete. Did I get these? No, not yet. Momentum and the potential to break. 1036, 1036. So you had a 50-50 look, not a clear path. Entry on the wrong side of the triggers, and then Cav, here it is again, man. The small triggers behave as support. And once you get to the correct side, it's easy money. That's your NASDAQ lesson, guys. If you're dying to be a NASDAQ trader, if you're dying to take those trend trades, you got to pay attention to the small chart, small triggers. Waiting for the gap theory to play out. Large triggers are a full bar away, and Pete's sitting on his hands. Pete's saying, man, it's likely to retrace back to those triggers. I'm going to sit on my hands, and I'm going to wait and see what happens. And Bob B, odds favorable. You're in at 35. So this time you didn't. I like it. Clear path. Easy peasy, right, Bob? So I love that you respected the termination condition, and you respected it here as well. And you still made money without having to trade into a termination condition. That's a wonderful thing. So it can be done. You're doing great, man. Guys, every now and then I get comfortable with you, and I'll play with you a little bit. All right, Rob, this is the same picture. 0675. All right, I like this one. So it looks like this one you're in over here. 911, 911. So Rob, I don't know where your entry is. Oh, you know what it is? Okay, I see what happens. Is this entry shows up as a... No, it's not even timestamps. This entry shows up, but this is your position reversed at 0675. So you held through all of this, and then it comes back down. So this is your entry. And I guess that was, I don't know what that was. And I see the reasons for entry. Good stuff. I don't see any stops in play, but I do see the limit. And Rob, this may be the challenge, man. I don't know where your stops are. I see a target. Are you trading without stops? And that's your right. But in day trading 101, so you're telling me that in this trade with no momentum and everything changing, your stop is at least 25 points up? And that feels like, okay, it's not my job to question your plan. I'm not a math guy. I just want to see something real quick. 50 times 25 is 1250. But since it is the micros, you're risking like $12.50, which is the equivalent of $1,250, and you're risking $12.50 to make 15 bucks. That's not right. Hold on. I'm doing my math wrong here. Every point is 50 bucks. Every point is $5. So you're looking to make 30 bucks here. right? That's a $30 trade. But from 06 to 36 is 30, 550. So you're risking $150 for a $30 trade. And you don't think if the market gets all the way up here, maybe things have gone south? That's okay. If it's your plan, dude, it's your plan. I can't make sense of it. I would love to know the whys. I would love to know why you're willing to leave that much risk on a trade when clearly everything has probably gone south in the trade. 30 bars means that odds favorable is implied. Strong trending market. Absolutely nothing in the way. Sell the mid-band until it stops working. Right, Trina? Talk about taking the lesson and applying it instantly. And there it is there, too. Sell the mid-band, sell the mid-band, sell the mid-band. And just keep doing it till it stops working. Trina, it will stop working eventually, right? Okay, you have to accept that. Guys, this is not a high probability trend trade. This is trading a strong trending market. And a strong trending market means that there were 30 bars minimum without a reversal bar. And those small triggers are riding the large triggers, and we just assume that momentum is in play. And when you have this look, you're never going to get an area inside of triggers. And it's literally sell the mid-band until it stops working. But guys, if you don't have a strong trending market, it doesn't work. No worries, Kev. Nice job, Miss Trina. Because we talked about that yesterday, I think. Strong bottom, beautiful, odds favorable, perfect. You've got the split, right? Didn't move it in time, would have been a winner. Absolutely. It's a great trade. Rough management. Everything says up. You get a tiny little pullback and you get in and you're able to make that money. Nice job. 2 times, Miss Trina. Pete, weak top, odds favorable, momentum, 41. Where's 41? You're letting it get below the fib. And again, you're running those super tight stops. And then with the potential to break, you take the medium probability trade and it just doesn't work out. And you know what? You had the potential, Pete, 100%. One of the things that you're missing, Pete, you don't have your synthetic triggers over here on your large chart. The 21 showed up. This 5-1 didn't for some reason. That would have helped you a lot, I think. But that's a good look. Large chart, small chart, it's a good look, Pete. It just didn't work. That's it. Just didn't work. Rob, same trade. You got in down here. This is the same trade. So you go short with everything going up, and that's the one that you held. And if you just waited for it to go down, you get the exact same entry to the target. Good stuff, Rob. I'm glad you're getting paid. I hope you're getting paid consistently. Miss Trina. Oh, Miss Trina. You see that giant gap back to the large triggers? See that huge amount of risk? Bad bottom, Trina. After a strong trending market down. So first glance, it's a good look, right? But in a market that has been railing south for the last 30 minutes, 2750 to 22. Is it worth that much risk? You got to watch those large triggers. I think that would have helped out a lot there. And we're going to get into that lesson that we talked about yesterday on those split triggers and making decisions. Cav, everything says up, you go up with it. Cav, I think you are now the most boring trader in the world. Hey everybody, look at me. I have momentum. Hey everybody, look at me. There's nothing in the way. Hey everybody, look at me. I'll enter an area inside of triggers and just keep getting paid. Great job, Cav. I'm giddy over here. Absolutely love it. Man, Todd, that's it. That's it. All right, Tom. Tom, you know I'm going to ask, right? Why? Why did you get in at the mid-band directly into a termination? Why did you exit at 1-to-1s? Did you use the small chart for entry? Or, Tom, did you say, I learned this cool lesson that price tends to return to the large triggers, and with momentum, it's a good spot for an entry. But respectfully, and guys, I'm telling you, I'm so specific every day that if you just do me the honor, the favor, the privilege of telling me why you did what you did, guys, I'll give you everything in my arsenal. I'll give you everything that I own rattling around my brain to help you do it better. I promise you that. I have to assume that it was an uptrend. You wanted to go up. And because of momentum, you wanted to go up. And you didn't care about this termination condition. See, but Algo, how the hell am I supposed to know that, Tom? What do you guys think? Do you like my puppy? Does everybody think my puppy's cute? Aw, it's not my puppy. You guys should know that. That's not my puppy. That's just a puppy. That's a horrible analogy to say, guys, tell me what you're doing. Tell me what you're thinking. Just because I see a picture of a dog, I can assume it's your dog, but it's not, right? But when you have momentum and path, beautiful. There it is. That's the one. Todd P. This is boring trading. Everything says up with momentum. There's not a damn thing in the way. Take the entry. 3 divergences can kill a trade. 4 divergences, it pushes, probably would have hit your stop. That's boring trading. And Tom, I'm not trying to beat you up, but if you really want feedback, you got to tell me why you did what you did. Absolutely, Todd. If you really want feedback, you got to tell me why. Otherwise, I can look at it. I love feedback. That's my favorite part of the day. All right, guys, I'm going to take 2 minutes. And when I come back, this is what we're going to do. So this was my big failure yesterday, was not recording this lesson. So I'm going to drop it in the room for you. There's the PowerPoint that I built this morning. When I come back, we're going to open up that PowerPoint. We're going to look at it together, and we're going to talk about when the entry isn't perfect. So I'll be back in about 2 minutes, guys. Marky Mark, I typically don't. I use Snagit. Let me share it with you guys here. So TechSmith Capture, let me bring it up. TechSmith Capture is pretty awesome. It's a free tool. But TechSmith Capture is going away, guys. They're getting rid of the free version. Mine's not either. I'm having challenges with it. I'm going to try to re-download it so I can teach it. Guys, they're doing 20% off single user licenses right now. For Snagit, you can get a free trial. Give it a try. But Snagit is, how much is it? And it's 20% off. So right now, Snagit individual is 31 bucks, guys. Snagit will allow you to take pictures. And I don't work for Snagit. But even cooler, Snagit will let you take pictures and paste them into pictures. So you can do like multiple pictures in one picture. You can take, like you can piece them together. That's what this is. This is two separate pictures put into one to create one. So I don't know what they're doing with the free. I don't know why they're changing it or what's going on. But if you're going to do this, guys, and you're going to get the feedback and you're going to go through the path and do it, that's a small investment. And Snagit has all the bells and whistles. It has like 32 million colors. You can create your own colors. You can do all the different text options. You can make this any way you want. It's got all sorts of different themes. It's got any shape that you want. It's got all the stamps. You can do fill colors, move, highlighters. You can draw. I mean, you can do like a big happy face. You can do everything with this. I don't endorse products. They're not paying me anything. But I can tell you that I am over the moon happy with Snagit. And it's just capture software with the bells and whistles, guys, with all the good stuff. And maybe skip that cheeseburger at Chili's this afternoon and make the investment. If you're going to really do this, it's a great investment. All right, so I'm going to go through entries, guys. Here is the extracurricular entry lesson. So we're going to start with the best look. This is the look that I teach every day. And guys, feel free to interrupt if you have questions with it. So this is the highest probability trend trade entry. This is the sequence to get it, guys. Wait for the reversal bar, because the reversal bar signals the beginning of the pullback. Define the retracement zone from the bottom of those triggers to the top of those triggers, because you have to buy in on the capture software now. Oh man. I've had it for so long, I haven't even gone through to look at it. Trigger lines define the retracement zone. Areas inside of the triggers define the bounce spot. And you know that your stop goes 4 to 5 ticks above the large triggers. This is the same entry plan that I talk about every morning. This is the same look, the same pattern. And guys, here it's good, right? You've got the areas, they're in the zone. Life is awesome. Can you give me a Y if you can hear me, please? Thank you very much. All right, guys. So is everybody good with this? This is the one that we talk about every day. When I bore you to death with the same darn rules, that's it. That's the best look. Sometimes it's not perfect, guys. Maybe the large chart isn't perfect. Maybe there's a huge division in the triggers, right? But if you know the perfect look, and let me back it up. If you know the perfect look, on a large chart, you can say to yourself, this isn't the perfect look. This is a 50-50 look. This is a medium probability trend trade look. And I want to show you how understanding the entry rules will help you make decisions. And this is what we talked about yesterday. And we talked about this based on on Pete's dismay for a mid-band floating in between the triggers rather than being inside. So in this particular one, the large chart has strong triggers, it's odds favorable momentum, and it's a 50-50 look. The small triggers have broken through, the large triggers have not. So this is the zone where the retracement is most likely to occur, from the bottom of the triggers to the top of the triggers. This is the very basic approach that we talk about every day. Since the reversal bar is already in the first retracement zone, it stands to reason that it could also go to the second higher zone. So we've got a really big area, right? And before I ever take an entry, I know that my stop goes 4 to 5 ticks beyond. This is the basic rules management approach. Does that make sense, everybody? Are you with me so far? I did this at 5 in the morning, so if there's an error in there, help me out. So we go to the next picture. The areas inside of the retracement zone are the spots most likely to create a bounce. Again, we go right back to the language, to the very basic. And the stop still goes where the market shouldn't. So from the lowest point, guys, you know that you've got $200 per contract of risk on this trade. Is everybody with me? Because the stop goes where it shouldn't, and the very basic entry rules say get in at the lowest point. Now, let's ask ourselves, say to ourselves, because it's not a high probability trade, am I willing to put $200 of risk on this trade? And some of you are and some of you aren't. There is no wrong answer. For those of you that say it's not perfect, I need a better option. That's what this lesson is for. So some people, because it's not high probability, some traders say if it doesn't get to the highest point of resistance, where the least amount of risk is possible, I choose not to take the trade. Guys, that's your right as a trader. Nobody's ever going to force you into a trade. Nobody's ever going to make you take a $200 per contract risk trade. You make that choice yourself. And some people might say, the only way I'll take it is if they get to that upper level, because that gives me the least amount of risk. That's one of the ways you can do it when it's not perfect. Other people will say, well, if it gives me confirmation from the area inside of the retracement zone, I'm willing to take that trade because that redefines where the market should not go. And now it's not $200 per risk, it's less. And guys, if you look at this, if you took the first one, you probably got stopped out. But if you took the second one, it worked out. And what you're saying is, okay, it's not perfect. Let me force the market to confirm. And that confirmation doesn't guarantee a win, clearly, but it at least reduces risk. And again, this is your right as a trader. But Trina, if it's the perfect trade, if it's odds favorable momentum, if it's a clear path, right? Back it up. Boop, 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 boop. If it's perfect, do you really want to get in on a confirmation bar and not at the area inside of triggers? No. So guys, you've got to use your knowledge base to help make decisions. So this is another way to do it. It's not perfect, but with a little confirmation, I can reduce risk. And then there's some of you guys that say, gosh, it's so freaking wonky. I still agree that the market's likely to go down. The momentum says it's likely to go down. The area is likely to break. I'll let a full bar on my small chart get below all the trouble because there's just too much nonsense up here for me to feel good about it. And I'll see if I can ride that momentum down to the next area. And guys, this is just jumping in. And most people, if they just jump in, they'll say, if I get a couple ticks above that area that I was hoping would break, I'll put a stop there. This is late in the move, guys. And if that area doesn't break, if it goes a couple ticks and then reverses, you're not winning the trade. But this is another way that I see people do it in the room. So there's different factors that go into it. And that may be the last picture. Nope, there's one more. This was my summary. This is your trade, guys. Every time you choose to enter the market, you're making that choice. Nobody's making you do it. And when you understand the entry rules at their most basic form, guys, I embrace language. Take care, Cav. I embrace language when I talk about my rules. When I know where the retracement may go, where I know where the bounce may happen, where I know where my stops have to be, I can determine what best suits my needs, guys. I can decide. I can make the decision that I don't like this entry because it's too risky. I can make the decision that it has to go up here because that's where I'm comfortable with the risk. I can make the decision to not take it in this zone at all and try and catch it on the way down. And none of them are wrong, guys. None of these entries are the wrong entries. I'm not even saying it's a way to reduce risk. Can you guys hear me okay? Boaz can't hear me. I want to make sure. Okay, cool. So Trina, let's not even say reduce risk. If you wait for the highest level, that's a way to reduce risk, right? And if you compare the $120 versus the 200, I suppose, yes, that's a way to reduce risk. But the key is understanding what the role of the indicators has, right? When I have momentum, I like it. If I'm losing momentum, maybe I don't care for it. But I think that when you use the idea of the rules, right, you can decide what's best for you. And the only way to figure out what's best for you is to do some study, to get the repetitions, to see the same thing over and over. And if you start from this basis, if you start from this basic approach, Trina, then you have something to build off of. And then when you see this look, and I love that I've got your picture, and then when you see this look, Trina, you can say, holy shit, pardon my French, that's a lot of risk. I'm not comfortable with this risk. Let me force it to give me a reversal bar, because then I can redefine where the market shouldn't go. Does that make sense? And this is a great example. With this much risk on a trade, if you had forced a confirmation bar to cut that risk in half, you would have never entered the market. So I guess, yeah, it is a way to reduce risk. And the confirmation bar doesn't guarantee a win. Not by any means. But what it does is it means that you don't have to put $300 of risk on a trade if it's not the perfect trade. And let's come back to all this bouncing, right? Everything is up, the path is clear, life is good, and you have one area inside of triggers. Trina, it doesn't make sense to wait for confirmation, does it? Not at all, not even a little bit. Let's see if we can find an idea where it does. And this is what we talked about yesterday, guys, so I wanted to try and turn it into a lesson. This was at 11 a.m. So Trina, everything says up, and you have a clear path, and the momentum is good. And Trina, you don't really have an area inside of the triggers, right? Your mid-band's on the wrong side of things. Do you see it? And it looks like this. So Trina, you can say, I'm on the wrong side. I don't know if, when, or where this thing's going to bounce, but I love the large chart look. The large chart look is sexy. I feel a little bit tingly, and I want to tell my friends about it, and I want new users to recognize it, but my entry is very difficult to define. I'm already where my stop should go. Well, I'll force it to confirm the move. I'll force it to reverse off of the area, and then I can put my stop here. And Trina still didn't get a winner, but at least you could define risk. Does that make sense, everybody? And this is one of those cool things that you can do. Great example. Here's a mid band, has all the momentum, and I think this is the one that that Tom, that you showed us, right? So assuming that the termination condition isn't there, there's an area, and Trina, your risk goes all the way down here. You could say, I choose to let it confirm so I can put my risk behind it. And I think that's a great example right there. Cool. So I think that it goes back to, again, it goes back to understanding what the best look is so that you can say to yourself, it's not perfect. Maybe it's not worth the risk, right? Maybe I have to find a way to have less risk. Maybe I need to wait for confirmation. Maybe I need to just sit it out because hell, that's a lot of risk. Same thing. Odds favorable, clear path, and this was right here, right? So there's a great look. Large chart is absolutely perfect. Wouldn't you guys agree? But small chart has a huge division on the retracement. And if I get in at 06, my stop has to be 11.5. 5 points of risk. Guys, I don't know about you. It's hard for me to get on board with that much risk on a trade. There's too many great opportunities. So I might say, you know what? If they give me that reversal bar, I can cut the risk in half and I'm pretty comfortable with it. I can go to 8 ticks instead of 30 ticks. And I think that is one of the great ways to use it. And we used to teach this on the split triggers, and Muser's in here, and Muser's the one that really turned this into a lesson for us. Is he would say, dude, it's not perfect. The triggers are split. And let me see if I still have that picture in client trades. I have to unhide everything. I don't know how to unhide things. But I used to have pictures of split triggers. And what the split triggers picture was, let me see if I can find it because it's a good picture. Well, heck, I don't know where it went. Once you have those split triggers, the indecision arises. And when that indecision happens, you want something a little more specific. Here they're almost together and the areas are tight and the risk isn't horrible. Might be a good reason for an entry. Here it's directly into a termination condition. No reason to take the trade at all. So good lesson. This is what we talked about yesterday, and I think I'm crashing NinjaTrader there. I did. You can't scroll and draw on NinjaTrader that much and keep it alive. But I wanted to go back and revisit that lesson because I think that's a good one, right? I choose. Morgan, you got dad jokes. You are ready for marriage, my friend. But I think this goes back to, why do I teach the best way first? Because when you can say to yourself it's not the best way, you have the ability and the right and you can change your plan. If you need to, you can change your plan to reduce risk. You can change your plan to adjust targets. And once you get to that point, you'll find that you're able to do that. And that's a pretty cool gift to have, I think. Good stuff. We've got about 20 minutes, guys. You know what's funny, Morgan, is I even thought, wow, did I sneeze? We've got about 20 minutes. What would you like to talk about? Steve, did that help? And I dropped that PowerPoint in the room too, guys. You can have that PowerPoint. I don't need all this. Strong momentum, not piggyback triggers. You are 100% weak triggers, but everything says up with nothing in the way, and you find a way. With divergence, is this your entry chart, Steve? This is just a large chart. Everything says up and you go up. Termination holds and you go up. correct side of everything and you go up. Everything says up, clear path, you go up. Everything says down, you go up and lose. Right? You see how that one maybe not your best bet? You formed an opinion and it whipped you. And then everything says up and you jump in and you lose momentum and the small triggers roll and you get below, but you hold it and you get out. I don't understand that trade. And then pivot stop out, mid band holds, everything heads up and you go up with it. I like it. I don't see any rules. I don't know why. You say with divergence waited for the reversal candle. Okay. So with this divergence, you waited for the reversal candle? Is that right, Steve? You waited for a reversal bar? But on a 34, 1, 2, 3, 4, it took you 5 bars to get in. But why would you go long with a reversal candle with odds favorable momentum against it? With the smalls and the potential to break. And I'm not knocking your plan, man. Rock it out. Have a good time. But with divergence weighted for a reversal bar candle, how's it repeatable? Why are you doing it, right? Odds favorable momentum against it. Why did you go long? How do we avoid this loser? Why did you jump in, right? So, Steve, I love it. I love that you're busy, that you're active, that you're doing things, that you only took one loser. Is it repeatable? I'm sure you have the rules written down. I can't give you much on this. Odds favorable clear path, that one makes sense to me 100%. That's the easy one. And we did this the other day with Joel. This is great. Odds favorable, nothing in the way. I know 100% why you did what you did. I'd love to hear why you took that trade, right? I'd love to hear why this bar felt comfortable but this bar didn't, right? What were your reasons for entry? What were your reasons for entry on this bar, not this bar? And I know why you jumped in here, and I know why you took quick profits here, and I know the exact same why you did it here. So not busting your chops at all. Why did you hold through all of that? Okay. Moving fast isn't a trade plan. Moving fast makes it difficult to follow a plan. But what do your rules say, right? If you had to write a checklist to enter this trade, what would it say? If you had to write a checklist to enter this trade, and this isn't, and Steve, we've been doing this long enough, you know I'm not beating you up. But this is my checklist. Divergence prints, large chart, odds favorable momentum down, clear path down, go long. That's a crazy checklist, isn't it? But I'm describing this look, I'm describing that look, I'm describing the clear path, and this is the part that doesn't make sense. Whether it's moving fast or not. So how do I eliminate this mistake? How do I eliminate this loser? Well, I've got to go back and I've got to say, okay, don't fight trend. Don't fight triggers. Life is easier. I know, but so this is the same thing. That loser was a loss of focus, right? How do I know that? How did you guys know that wasn't my puppy? And annotations on the charts create a recipe, guys. Annotations on the chart create a recipe. They make things repeatable. And that's the goal, is to be able to do the same thing every time. All right, Todd P. This is all for you, brother. One-on-one session. What direction is the market trending? Up or down? Whoa, what color is the background? And this is going to sound silly. Are you colorblind? And I don't mean that ugly. Look at the most current bar for me. Can you see the green background? I had someone that was colorblind, and I can fix that. Well, you've got to look at the most current bar. So our first lesson on the large chart, trend is defined It's okay, Todd. I'm not beating you up, but what I'm doing is we're creating a thought process, okay? So the first thought is, what direction is the market trending? And you have to know where to find it. So this is a good one. And then once I define the trend, I have to define the momentum. And momentum is defined on the most current bar. And we're going to define momentum. And the momentum, do I have strong triggers? That's the second thought process. I can only have it if large, small, background agree in color. So when I open up my charts, what I'm doing for you guys that are brand new is I'm going through exactly what I go through in my head. First I say, what direction should I be looking? I should be looking to trade with the trend. Then I say, do I have the momentum that I need to take the trade? So here's your second one. Whoops, I don't know where that streams link came in. And then once I do that, whoa, look at that. I ask about the path. And it was right here. And I say to myself, do I have a clear path? And again, by the time we get there, do you notice that the large triggers aren't above? So I'm also going to define path. Not clear, it's a 50-50. And I'm going to go through all of this stuff before I ever even think about an entry. So I'm going to define, get up there. I'm going to define the trend. I'm going to define the momentum. Take care, Trina. I'm going to define the path. And that's all large chart endeavor. So what happens is if my large chart says down, I'm only looking for down. And if my large chart says I have a clear path of the potential to break, I'm going to go look for an entry. So entries come from areas inside of triggers. And the way we enter is with a limit order. So if I want to go down with the market, I'm going to right click above price. And it's going to give me an option, sell limit 3. And that's going to put a sell limit in there. And I need to put that limit order a little bit below an area inside of favorable large triggers. Does that make sense, Todd? So if you're going to sell, we want the market to go down. That's the anticipation. So if it hits your order, you're in a short position. Your targets are there, your stops are there. And I'm not saying that this is a trade, but this is how we're going to do it. And if the market were going up, and this is just simulator, we can do it. If the market were going up and my rules say buy a pullback, I'm going to right click below and I'm going to put a buy limit order in. And if the market comes back and gets me, well then I'll be in a long position. And that's the basis for entry. So anytime you're looking for an entry, I should be going with the background color, first and foremost. If it's green, I should be looking for my rules to be met up. So let's do it again on this one. On the most current bar, new users, what direction is the trend? What do you guys think? And I don't do this to put you on the spot, but if the answer is wrong, then it means we get to go to these great lessons and give you that knowledge base. What do we think, guys? Takes courage, right? Perfect, Tim. It's going up. The background is green, the trend is up. So what's the second thing? Large chart, large chart defines trend. It's up. And then it defines momentum. And do I have strong triggers on this first bar? My small triggers are inside, right? There's no space between the two. The scissors aren't open. Tim says no. Tim, I agree 100%. The answer is no. And that should be enough. Stop looking for a trade for the brand new user. But let's pretend that momentum was yes. Oh, no, I know, Todd. That's why I went through how to activate a limit order. And Todd, you should go through and just as a brand new user, activate limit orders, right? Jump into the market. Whoops, I can't jump in when I have a limit order waiting. Jump into the market. Learn how to move your stops. Learn how to move your targets. Like, that's the beauty of Simulator, is you can do all of these things over and over. But I'm taking this to that big lesson. First, define trend, then define momentum, and if the answer is a no on momentum, it's okay to stop looking for a trade. And let's say hypothetically it was a yes. Well, then I go to path. Are my small and large triggers above the problem line? They actually are here. And the path was clear. Do you guys see that? Both small and large triggers were above the divergence high. But without momentum, anything can happen. And look what happened. And then it just goes to the next one. What color? What's the trend, guys? Up or down? It's down. Do I have strong triggers? Are the scissors open? Yes. Do I have a clear path? What's the recipe for a clear path? Hold on, let me do this. The recipe for a clear path says first, price reaches an area. Did price reach an area? It did. Where are my triggers? That one's still above it. That one's still above it. Do I have a clear path? What do you guys think? I'm going to disagree respectfully. This is a textbook termination condition. So Todd and Tim, this is why I believe language is so important. The recipe to define a termination condition is price reaches an area. Where are my triggers? If my triggers, small and large, are still above the area, it's defined as a termination condition. No trades into the area. Does that make sense, guys? So why do I type on charts so freaking much? Because if you say this 100 times, price reaches the area, where are my triggers? The area is the divergence low, Todd. So again, here we go. I love this. We're going to run over today, and I'm going to love every second of it. Termination conditions defined. Watch this. Todd's like, but dude, I don't know which areas can be termination conditions. To which I lovingly reply, check it out. Let's go to the instructions. Let's go to the trading guide. Let's go to the termination conditions section. And Todd, now you have a list of areas that can behave as termination conditions. Blue Fibonacci support, red Fibonacci resistance, yellow 1-to-1, cyan divergence low lines, that's the one that we saw there, magenta divergence high lines. Remember, they can be horizontal lines on a large chart. So here's that picture for you. And this is why we do it incrementally. And this is why I don't say, hey, here's your trade. This is why I say here's the advantages that create your trade. So I have momentum. I know it's a downtrend, but I don't have an area inside it, or I don't have a clear path. So Todd and Tim, look at what the market did at that divergence low that absolutely none of the triggers broke. Pretty fan-freaking-tastic, right? And now it's up, and now I have momentum, and now my path is clear, and now I activate a limit order 2 ticks above the highest point of support. And that's a high probability trend trade. Pretty cool, right? But that's how fast it happens. My stop goes 1, 2, 3, 4, 5 ticks below the triggers where the market shouldn't go. I had a termination. I have momentum. Whoops. And I lost that one. That's a cost of doing business. And now we're going back down. And guys, what's happening is your market's consolidating. And do you notice that that consolidation is splitting a fib? It's splitting an area. They're making decisions. They're fighting it out. And until we really get that clear path, whoop, I ignored 3 divergences in the same price range. Does that make sense, Todd and Tim? First define direction, then define momentum, and then define your path. And what you'll find is that if you adhere to those 3 very simple rules in the beginning, you can find an extraordinary level of success with the software. But it takes a little bit. Give yourself a little bit of grace, guys. It takes a minute. There's that divergence low. Stop in the market again. The same way that did. 3 divergences, yep, once it reversed the market, it was. But Tim, that strong top didn't mean anything into a termination, did it? Just because it's a strong top doesn't mean you ignore termination conditions. I would say don't even worry about strong tops and bottoms yet. Be able to identify trend, be able to identify momentum, be able to identify path, guys. Once you can do that, you have everything you need to find success with the software. Hell, some people just jump in. With everything saying up, I'll just jump in and see if it keeps going up. And if I get a reversal bar, I'll exit. But if I don't get a reversal bar, I'm just going to ride the momentum up. That's not a trade that I teach, but a lot of you guys do it. That's why I don't teach it. And that's it, guys. That's today. Guess what we're going to do tomorrow? Tomorrow, we're going to talk about momentum and path, guys. We're going to talk about entries. So I'm going to keep doing this every day. And every day it's going to click a little bit more. But what I really want you to do, if you're brand new with me, I want you to go back and I want you to circle tails when there's odds favorable momentum and nothing in the way. So, Todd, you're working with Chris, right? 2 things. Here's the instructions. This is all the Ninja Trader stuff. Pick up the phone and call Chris and go, hey, Chris, do me a favor. Get on my computer and walk me through some of this stuff. We can do some of it tomorrow for sure. But here's most of it right here, written out. But the mechanics, once you do them a couple times, it all falls into place. But Chris will do that for you, and then I'll do it for you tomorrow. And I'm going to address that, Todd. You don't have to ever do it on your own. That's what we're here for. I'm here to make sure that you never have to do it.